able to talk to each other.
The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
This week, they talk about $500 billion plus in annual federal expenditures that they say are unauthorized by Congress or being used in ways that Congress never intended. They cite things, Maya, like Corporation for Public Broadcasting, Planned Parenthood, and some grants to international organizations. Would that actually get bipartisan support?
Excellent question. So I think there's something to be said by having outsiders who go look at the budget with a fresh pair of eyes or a couple fresh pairs of eyes. But they're also going to run into a lot of roadblocks because they're not familiar with how Congress gets things done. Yes, there's about $500 billion in unauthorized funding in the federal government. Much of that is because there's so widespread support for those programs. You name something. The biggest item of unauthorized spending is veterans benefits. That's the area that has just swept through Congress in past years of getting increases, bump ups. Nobody's going to step back from veterans spending that I can imagine. And so I think they're going to bump into a lot of roadblocks there. Many of those programs are unauthorized because they just jumped to the point of putting them through the budget. So the big question, as you point out, and as it should be, you can't just have outsiders saying, this is what we're going to cut, this is what we're going to toss out. It needs to go through Congress, and Congress has a lot of preferences that will not align with the kinds of things that are being floated, I think.
If you make people come back to the office who are government workers, will that allow enough attrition to really save the money that is needed?
That's not the right way to do it. Now, I think that talking about having people come back to the office, absolutely the right policy. But what you really want to look at is what agencies are bloated. Department of Agriculture, for one, has more people than it needs to do the jobs it does, by all accounts. And what departments, even with the savings and with the regulatory reforms that they're talking about, wouldn't get the same amount of savings by arbitrarily cutting people. You don't want to take a meat axe to this. You want to think about where there are redundancies and inefficiencies within personnel, and that's how you think about it. So coming back to the office, yes. Using that as a way to slash your workforce, no, we should think about it much more carefully than that.
Maya, in your note, you also talk about the fact that Presidents Reagan to Biden, even Trump, were talking about how to really fortify the IRS and that tax gap. But when the Biden administration tried to make the collecting taxes easier, the Republicans really pushed back on this. What kind of appetite are they going to have in this Congress?
Let me tell you, that's one of the things I'm very worried about. So as a fiscal watchdog, we don't believe in free lunches. Very few programs pay for themselves. Tax cuts don't, spending increases don't. Putting money into the IRS is one of the very few areas where you can actually get multiples return on what you put in. Just because it needs more help so taxpayers know what they're doing and that there's enforcement in certain places. Sometimes we talk about it in a way that makes it sound easier than it is, but this is a very productive investment. I'm worried that rescinding those IRS dollars will be used as a slush fund to offset other bump ups in spending. We have spending caps for this year, if they ever pass a budget for this year, which they don't appear to be on track to do. And Congress will be trying to get away around those caps. Getting rid of the IRS funding isn't the right thing to do, in my opinion, because it does pay off, but you see a lot of support from Republicans for rescinding those dollars. Absolutely.
Maya, a lot of people who come on our show say that the ultimate punisher, the ultimate check will be the bond market. And I'm looking right now, and yeah, you've seen yields go up on the long end, but this hasn't been some sort of mass bond vigilante protest that has caused a complete change in the tone in Washington, D.C. What would be required to sort of get the attention of people in D.C. for imminent action in the bond market at a time where a lot of people are saying, well, you know, you still see a lot of people willing to buy?
Yeah, I thought that point that your previous guest made about all eyes will be on the bond market, whereas in last term, all eyes were on the stock market. I thought that was an excellent point. There are real risks right now. There are real concerns in the market that we haven't seen in past years. And I think if there are signs of inflation and if there are signs of those rates continuing a steady march up that are driven by concerns about the excess of borrowing that it looks like we may be on track to go on, that the administration will rethink some of its plans to borrow. It has plans to do a lot of borrowing up front and then talk about spending cuts or savings down the road. That's not how you're going to reassure markets. They should pair those two together. And so that the so-called bond vigilantes will understand that all the policies that the Trump administration is talking about won't add to the debt, because if that's what drives up even small ongoing increases in the bond market, I think you will hear more and more growing concerns about it.
I hope you get to speak to Elon Musk soon, because I know you've got tons of ideas. Maya McGuinness there, the Committee for a Responsible Federal Budget. Appreciate your time. I wish they could simplify taxes in this country. If you're W-2, and we are, withhold the right amount. Don't make me guess at the end of the year.
Yeah.
I'm not doing deductions. Why should I need to do a tax return?
I couldn't agree more. Make tax returns great again.
Right? Well,
The UK does it like that.
This is not difficult.
Simple. I would agree. Who likes doing taxes? Actually,
nobody.
They can be kind of fun.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lyons deliver news, insight, and analysis live every trading day. Balance of Power live around the world every weekday, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Still recovering from the idea that Lisa enjoys taxes. Not letting that go. It's the most Lisa thing ever.
Yeah, you can kind of see it, right? Well, it's cathartic. It's just sort of
enjoy the pain of doing it.
It's just, plugging in numbers and making them all add up. It's great.
Right.
I'll give you my
Futures,
taxes.
Negative by 1/10%. Mine too. On the S&P 500. On the NASDAQ, we're down by about 0.2 with some movers this morning. Your morning movers with Manus Cranny. Good morning, Manus.
Jonathan, good morning. You're learning pretty much everything that you thought you knew about the discounters this week. Ross Stores come in and they are saying, look, we're going to guide to the upper end of our band, $6.10 to $6.17. So that's moving up in terms of the guidance. Lower, here's a shock headline, lower income consumers still feeling pressured, but they are able to eke out margin expansion. Freight rates are a little bit lower and they're not having to discount just as aggressively. So that is bid this morning, $47 billion market cap. Compared to, roll it over, have a look at Gap. This is a shocker, 47 billion to 8 billion, and yet the sort of marketing presence of Gap is so much more. Think of Old Navy and Athleta capturing 7 quarters of straight gains in sales. They've raised their guidance as well. Richard Dickinson certainly delivering on reinvigorating the brand, the merchandise, Jennifer Hudson obviously collaborating with them as well, and they've only got a 10% exposure of their supply chain to China. That's going to become the go-to stat that you want to sort of gallop through the S&P 500 along with the rest of the stocks for next year. Hospital stocks are under pressure. So this is the personification of just one of them, but it encapsulates 8 days of pain. 8 days of uncertainty, 8 days of the risk of a sledgehammer to health. There's going to be a shake-up, whatever way you talk about it and look at it. Hospital stocks, biopharma stocks, we're aiming towards a shake-up under this Trump nominations of RFK Jr. and Dr. Oz. This is merely a personification of 8 days of angst. Jonathan.
Manus, thank you, sir. We'll catch up with you again in about 60 minutes' time. Under surveillance this morning, President-elect Donald Trump considering Kevin Walsh for Treasury first and then the Fed. The Wall Street Journal reporting Trump discussed the potential agreement, the arrangement with Walsh early this week at Mar-a-Lago. Ukraine saying Russia launched a new kind of ballistic missile. President Volodymyr Zelensky saying the weapon had all the characteristics of an ICBM. Russian President Vladimir Putin saying the attack was retaliation for Ukraine's use of Western missiles earlier this week. And finally, Apple is racing to develop a more conversational version of Siri. As competition with OpenAI's ChatGPT and other virtual assistants continues to ramp up, sources telling us here at Bloomberg that the new Siri uses large language models to allow back and forth conversations. It will eventually be added to Apple Intelligence.
Okay, that's so dangerous. I mean, honestly, I know that when we got Alexa, the kids immediately went to it and started asking all sorts of questions. Do you like me? Do you like yourself? When did you die? I mean, all of these questions, you can just imagine.
This sounds existential. So basically what you're saying is maybe this is a Siri that can also become a friend. What I find so striking about this, and great work by Mark Gurman, who scooped this, is this wouldn't even really be rolling out till 2026. So we're talking about it now, at the end of 2024.
How are you keeping it together?
How long do we have to wait for this to actually come out? But it's needed. Because I remember once I was asking a guest a question, and it picked up on, I didn't even say Siri. We need a better version.
What goes on at Lisa's house? That's what we all want to know.
Well, it's just you want to test the limits of what's in the program, and now the limits will be that much widened.
Let's turn to Europe. Traders ramping up bets on a jumbo rate cut in December by the ECB as Eurozone PMIs contracted in November, feeding concerns about the state of Europe's economy as it faces down the prospect of higher tariffs from the incoming Trump administration. Joining us now is a man who has a say at next month's meeting, the Portuguese Central Bank Governor, Mario Centeno. Governor Centeno, thank you for being with us, sir. We appreciate your time. It's important to point out that every official on the Governing Council has a different view. And at a time this morning where people are questioning whether the ECB is behind the curve, I think it's important to highlight your more recent comments suggest you are very much ahead of this weaker data, anticipating it and worried about it. We'd love your reaction to this morning's economic data and whether you believe a 50 basis point rate cut should be on the table at next month's meeting.
Well, thank you for having me, and good morning from London. Well, we have to take this data in the context of all the information that we now have to take a decision next month. We will have also new forecasts. My first reaction is that this data certainly confirms the appropriateness of the decision we took in October, and the profile that we now have for the trajectory of interest rates also going forward. This is the appropriate message that I'd like to send. We know, I mean, the challenges ahead. We know that the euro area economy is struggling to recovery. The most important, though, is that inflation is on target, and we need to move according to all these data. Today's information goes along the way, indeed, I have been looking at the European economy. it just confirms that we need to move in monetary policy.
Governor, how quickly you move is part of the conversation, and whether you should be constrained by 25 basis point increments or not. Do you believe larger reductions should be considered in a month from now?
Well, we have been discussing that for a while. I rather prefer us to move gradual, and gradual means steady and with predictable steps. But of course, if the data confirms that the risks to the downside in growth materialize, that the numbers for inflation that we still are expecting these months go in the same direction, we can certainly discuss and be open to discuss different steps. But what is more important is to send a message of we are doing our job, we are moving interest rates in the right direction, and we will continue to do so as long as data requires.
As you know, and from listening to you and your colleagues, the focus so far has been on normalizing interest rates, which speaks to that gradual approach. Governor, when I look at the data out of Europe, when we all do, when we see Germany barely growing and the PMIs in contraction, I think quite rightly the conversation is changing in financial markets to whether you need to be accommodative, whether we should be constrained by this idea of normalizing and moving in gradual steps, or whether we should be open to becoming accommodative and moving much more quickly. What's the difference between the two for you?
We do know that we are still in restrictive territory. The interest rate is above the neutral levels, and so this means that the path going forward will be to continue to reduce the level of interest rates. We also know that the biggest problem in Europe is investment. And investment is certainly quite sensitive to the interest rate, so it will be also of importance for us to have the support of the economy so that inflation can remain at 2%. We don't want to go below 2%, and for that we need a stronger economy. So it's the combination of those two that need to be on the table so that we take a decision that so far brought us in a stable path, which is always important, to 2%, and now we need to make sure that we continue there.
Governor, if I could put you on the spot, a pointed question. Do you believe the biggest risk right now is above target inflation or below target inflation? And I'm not talking about next month's data. I'm thinking about a medium-term view, looking out several years. What is the biggest risk, above target inflation or below target inflation?
Well, the history of Europe in the 10 years prior to this inflationary experience was below target inflation. And the fundamentals for the European economy didn't change much. So, in my view, we need to be concerned with below target inflation. The risks that we face today, both from the economy and from shocks outside Europe, take us in that direction. So we need to focus on not going below target in terms of the medium term, because then we open up again the issue of, as you are saying, normalizing monetary policy. We were successful thus far to bring inflation to 2%. Now the job is a little bit different. It's like, you know, this last mile not being a pass from above the target, but from below the target. And it's not easy. It proved not easy for the Eurozone to bring inflation close to 2% before 2019, and we need to be very serious about it.
How much do you think that on a broader sense the ECB needs to consider, I don't want to say a dual mandate like the Federal Reserve, where you're looking at employment as well as inflation, but the growth backdrop as well, as maybe there's going to be that bumpiness that you talk about in the near-term path of inflation, but the longer-term path, you see that risk as significantly to the downside when it comes to that disinflation?
Well, I don't think we need to discuss the dual mandate or the single mandate that we have. We just need to remind ourselves that inflation is an endogenous variable. It is strictly connected with the way the economy goes. By targeting inflation, we are somehow looking at a broader set of data and see how it interacts with prices. The labor market, certainly, unemployment, employment, the dynamism that the European economy had recently on the labor market is very important, and it's also our job to protect it, to preserve it. That's not because of the labor market on its own, which is already important, but it's on the impact that this may have on inflation. We do know that an economy that doesn't grow, that doesn't invest, will not be compatible with prices at 2%. So I always look at this in a more broad sense. So for me, honestly, the thing of the dual mandate is not an issue.
Governor, you brought up shocks from outside of Europe. I'd like to talk about those shocks with you. The prospect of a change of policy in the United States following the US election, and whether that introduces a new risk that you have to confront. If the walls go up, if the tariffs go up in America, and we're all concerned about overcapacity in China, there's one place that's going to have to eat that overcapacity, and it could be another disinflationary threat. That's Europe. Can you walk me through your understanding of the policy changes we might see in the next year and the kind of risks it introduces to your outlook?
I totally agree with you on the way you put the risks that the tariffs and the spare capacity that we see around the globe will imply to inflation. So I see these shocks from an economic policy perspective as a wake-up call for Europe. Europe needs to move from the passenger seat that very often we see Europe sitting comfortable to a more leading role in the world. That will call for an increased role for the euro internationally. We were discussing that back in 2019, just prior to COVID. We may be facing the same challenges right now, so we better focus on the response that Europe needs to do and to produce to those challenges instead of discussing what is going on elsewhere. We do know that we need to move very fast if we are presented with these challenges. If I may, I can quote here Elvis Presley and say to you that we can't go on together if those challenges from the outside present to Europe challenges that Europe cannot go along with.
So for the past couple of months, the ECB terminal rate is expected to be something like 2.5% by the end of next year. Putting Elvis Presley aside, given all of the potential external shocks and the current trajectory, do you think it ought to be much lower than that?
Well, I don't see reasons for the neutral rate in Europe to be much different from before this crisis. The fundamentals in Europe are pretty similar. We have a more dynamic labor market that will certainly help bringing the natural rate up, but probably it will not be enough given many other factors like demography and productivity that will still weigh into that number. So if we go close to 2%, probably below, it will be my best guess right now for the neutral to be. So we still have some way, some path to cover, and we need to be very much focused on that.
Interesting. Sir, we appreciate your time. With a suspicious mind, ECB Governing Council member Mario Centino. Thank you, sir. Appreciate it. A wonderful reference there to Elvis Presley. A lot to take away from that conversation.
Basically, just the need to look through any kind of near-term inflation, and that really this is going to be potentially a matter of how quickly not necessarily whether they're going to be cutting rates aggressively.
Next month is a really big decision for the ECB. Just imagine we could have a Fed going on pause and an ECB cutting interest rates 50 basis points.
The theme of the day, divergence, as you said. I mean, honestly, this to me is really going to be highlighted, and we're going to see it in the currency. That's what we're seeing right now.
Yeah, euro dollar around 104. Up next on the program, America's energy needs piling up.
What we now need is energy. We are prolific consumers of energy, and we're going to run out. There should be an AI for America initiative where the government works closely with the private companies and figures out a way to make sure that we are ahead of time.
That conversation up next, live from New York City. This is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, you can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I Ready? Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Equity futures on the S&P 500, just a little bit softer here. We're down by 0.1%, but recovering. In the bond market, a bit of a rally. Yields lower by 2 basis points. The 10-year 4.39. The rally in Europe even bigger than that. The front end of the German curve, we're down by double digits. Lower by more than 10 basis points on a German 2-year. Unlocking a ton of euro weakness. Euro dollar earlier on in the session dropping to 103. Right now 104 and negative 0.6%. Under surveillance this morning, America's energy needs piling up.
What we now need is energy. We are prolific consumers of energy, and we're going to run out. One estimate is that the U.S. will run out of all sources of energy by 2028 at our current growth rate. There should be an AI for America initiative where the government works closely with the private companies and figures out a way to make sure that we are ahead of time. The power of this technology upends society in so many ways, economically, the way we govern, the way we reach, language, and so forth.
So here's the latest. The energy sector poised for a critical chapter, with Donald Trump's second term set to reshape policy and the build-out of AI infrastructure putting huge demands on powering it. Raj Agrawal of KKR writing, digitalization, the energy transition and the digital power problem are massive challenges that require scaled capital and deep sector expertise to solve, but also present a tremendous investment opportunity to those with the ability to solve them. Raj joins us around the table. Raj, good morning. It's good to see you.
Morning, Jonathan. Thank you.
Thank you for joining us. Let's talk about those energy needs. Just start there. How big are they?
They're massive. If you take the data center business in the United States and you say, okay, how much power is required to power that? If you fast forward 2 to 3 years, we believe that there'll be, if you then aggregated that power, we think there'll be as much power consumed by the data centers in the United States as one of the top 10 countries in the world in terms of power consumption. So it's massive.
How much building needs to happen to accommodate that in terms of energy infrastructure?
Yeah, we believe it's about $500 billion per year for the next several years. So already we have, if you look at our own data center business, we have roughly $40 billion of assets in the ground, and we have a $110 billion pipeline. But that's a drop in the bucket, right? There's not enough capital out there to make this happen. And so we're working hard on trying to bring that capital to bear.
One thing a lot of people have been talking about when they come on this show is one of the big challenges to getting infrastructure for energy built is some of the permitting and some of the other sort of regulatory constraints. Has that been your experience too? Do you expect things to be expedited in a material way? Should there be some sort of withdrawal of some of these regulations?
Yeah, you know, it's the right question. There's a lot of constraints to building it out. So there's affordability, security. Is there just enough growth? Right? If you look back historically, power has not been a growth business. Right? It's been relatively flat for the last 20 years. We now think that there'll be about 2.5% growth per annum in power, and about a third of that coming from the data center business. And so the industry needs to respond. Part of that response might be easier permitting. Part of that response might be, more investment in renewables, more investment in natural gas, maybe nuclear coming in. So the industry is right now in a process to respond. What gives me hope is that everybody in the country wants this to work, right? This is one of the areas where the U.S. has a competitive advantage. And so whether it's Democrat, Republican, North, South, everybody's trying to align to make this happen and solve this problem. And so it gives me hope that we'll get there.
You had a statistic that I thought was amazing. The infrastructure has gone from about 1% of the private asset sphere to about 25% in the past couple of decades. And when I think of infrastructure spending, I think of airports and toll roads and LaGuardia. And yes, it's gotten a lot nicer. Is the majority of that infrastructure at this point largely the energy space and anything related to digital?
Yeah, if you look at how capital is being invested, I'd say it's roughly about a quarter in the digital space, probably a quarter in energy, including supporting digital, but also much more. Right? There's a whole electrification business that's much broader than just digital. There's asset leasing, transportation. So the typical airports, toll roads, maybe less than 10% of what's happening in the industry today. And therein, I think, lies the interest. Why has infrastructure gone from 1% to 25%? If you can invest in infrastructure with great assets and long-term contracts and protect capital, but expose capital to sectors like power and digital that have a ton of growth, you now have the potential for a tremendous risk-return profile. Protect capital regardless of what happens in the macro, but be able to generate attractive equity returns by all the growth that's there. That's what's really driven the interest in infrastructure.
Do you expect more deals like we saw at Microsoft and 3 Mile Island, basically restarting this nuclear plant? We've never seen that before happen, this restart like that.
Yeah, I do. So nuclear specifically will take a while. Right? This is the beginning of a lot of permitting, regulation, and capital expense. So nuclear might be part of the solution in 5 or 10 years. I think in the near term, there's going to be natural gas-fired power. There'll be a massive build-out. This will be a renaissance in investing in power, including renewables, wind, solar, power transmission, distribution. Nuclear would be part of it, not just a 3 Mile Island type project, but also small nuclear modular reactors. And so I think that's probably solving the 5 to 10 year problem, not the 0 to 5 year problem.
Just to broaden out to follow on to that question, how much of the money, and I know this is sensitive, you can't really disclose who your investors are, but how much are you raising capital from big tech themselves to actually invest on their behalf to get some of these projects started?
Yeah, they're traditionally not massive funders of us. Right? And frankly, I'd say they only have, their capital problem is not substantial. So they have tremendous capital to put out for this. When they're partnering with us, they're not giving us capital or they're looking for a capital. Mostly they're looking for capabilities. Our ability to be a solutions provider, to come to the Microsoft, Google, the hyperscalers of the world and say, we've got land and permitting, we've got power capabilities, right? We've been one of the largest power investors in the last 20 years. We've been one of the largest data center investors in the last 20 years. To bring those capabilities and to give them high level of certainty that we can deliver powered data shell when they need it, that's incredibly valuable. And so that's what we're trying to do.
We're only scratching the surface here. This is going to be huge for years to come.
Honestly, the idea that we talk about American exceptionalism, the whole show has basically been Europe, things are really rough. US, wow, such growth, it's incredible. And basically, you have to wonder who's going to be financing it and how much of that's really going to come from the energy sector.
You said it. Mohammed said it a few times. Mohammed Al-Erin, that sucking sound is just capital rushing into the United States.
You could see it with the flows this week. Basically, you have outflows from European bond and stock funds, big inflows into the United States.
Raj, it's good to see you. Appreciate your time.
Thanks very much.
Thank you. Raj Agrawal there of KKR. Coming up on the program, we'll catch up with Ed Yardeni of Yardeni Research, Dana Telsey of the Telsey Advisory Group, Tiffany Wilding of PIMCO, and Troy Gajewski of FS Investments. The third hour of Bloomberg Surveillance. Up next.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it, on Bloomberg Technology.
We are very focused on playing one game and one game only, and that is being free, frictionless entertainment for consumers. But what I will say is we are doubling down on the strategy. We believe it's working. We think the tailwind's in our favor, and it's on us to continue to deliver.
Whenever you're doing something innovative that hasn't been done before, there's a lot of trial and error and iteration. It just always has these zigs and zags along the way, and I think where we've been successful is really being reactive.
Hollywood is the history of technology. Like, we are here because of technological breakthrough, right? And so we sometimes forget that art and technology kind of like come together always. And for us, it's like demystifying a little bit the technology. Again, if you understand AI as a tool for humans, then it changes the narrative. And it's less about fearing it and more about embracing it.
Don't miss Bloomberg Technology, live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
I think we're renormalizing a yield curve if we've taken recession fears off the table.
As long as the underlying components and sort of drivers of inflation are still disinflation, I think it lets the Fed keep going.
They probably sneak in a cut in December, although even that's gotten to be a close call now.
I think that they can probably still go ahead and cut by 25 basis points in December, but next year is rather uncertain.
The objective has been to hold this soft landing, and now we're going to have melding.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. The opening bell about 90 minutes away. The score's shaping up as follows on the S&P, on the Nasdaq, on a Russell. The S&P 500 just a little bit softer through most of this morning. On the S&P 500 right now, recovering but still lower by 0.1%. We're down 0.2 on the Nasdaq. We're in positive territory on the Russell. The small cap's up by 1/3%, with a bit of a rally in treasuries, a much bigger rally over in Europe in the bond market, and a much weaker euro off the back of that. Euro dollar 104.10, negative by 0.6%. We talked about it all through the morning. The word of this morning, divergence, weakness in Europe, and better data in the United States.
I have to be honest a little bit. I feel a little bit guilty that we're talking about the pain of Europe and these PMIs and contraction, and then we're saying, look, it's going to be, the golden era, and we're going to see so much building and investment, et cetera. And you have to wonder, what are the limits to that divergence? And I think that's what people are going to be testing, and how much are we maybe overstating one or the other. But for now, very much front and center is the fact that Europe has a problem of secular stagnation and stagflation at a time where the United States is very much in a different picture.
This is years in the making. Jonathan, you've said it a million times. America innovates, Europe regulates, China replicates, and that's what we're seeing happen. And it's going to be far worse for Europe when Donald Trump gets elected. And the Portuguese central bank governor said this. He said, quote, "We're going to be dealing with shocks from outside of Europe." How much more difficult and challenging is the European environment going to get when the United States puts the tariff walls up?
They've got to balance a bunch of competing issues in Europe at the moment, but I think the dominant one, to your point, is the shock outside of Europe. How big these tariffs might be, and what it will lead to ultimately is a disinflationary impact on the European continent, potentially, that they're going to have to grapple with.
Especially at a time when potentially China is going to be trying to export their goods to someone, and they won't be able to get them to the United States, so they'll be exporting cheaper goods to Europe, and that's going to create that downward kind of trajectory. Christine Lagarde came out and was talking earlier today, and she said this: since last year, Europe's declining innovation position has come more clearly into light. The technology gap between the United States and Europe is now unmistakable. Real question is, how do you invest at a time where you're just trying to basically protect the fiscal picture, and it shows the difference of the fiscal dominance of the United States, the ability to borrow at a time of already strength?
Germany is at the heart of this. The German model has totally failed on three key fronts: energy security, broader defense, and then economic security as well. Across the board, relying on America for defense, big crack in that. Relying on Russia for energy, huge crack in that, demolished over the last few years. Relying on China for economic security, compromised by that repeatedly. And the list goes on.
Which is the reason why, when you see the German ECB members, it is a bit ironic that they're the ones that are most reluctant to lower rates significantly at the ECB at a time where people are talking about weakness and the need to potentially even stimulate, not even get back to a neutral rate. Mario Centeno of Portugal on just with us moments ago, saying that he sees the neutral rate potentially as around 2% or below that at a time where the collective view on the ECB is at about 2.5%.
This story's changed so quickly in just a few months, hasn't it? It's kind of ridiculous. In the summer, we're talking about Chairman Powell getting really, really dovish. 50 basis point rate cuts. We had this big dollar long built up. We were going to eat into that dollar long. We were now going to be dollar short. And then here we are again talking about building up a dollar long for a whole bunch of reasons.
And there have been a number of notes over the past 24 hours talking about how much of this is Europe and how much of this is the U.S. And the answer is yes. It's both, right? I mean, basically, you have better than expected data coming out of the United States and weaker than expected data coming out of Europe. The real key question now is what policies are going to be put into place in the United States and how much will we make good on the expectations or then some. George Saravelis of Deutsche Bank saying that only 30% of the Trump trade has fully been priced in and talking about he expects a lot more euro weakness to come.
It's not that the United States won't be without its challenges, and whoever's going to be the Treasury Secretary, whoever it is going to face some big challenges as well. Check out the names, you know them well. Bessent, Walsh, Mark Rowan, Senator Haggerty. The list is about 4 people deep. There is the prospect, of course, that Donald Trump, the president-elect, gets fed up with all of this and just throws out a completely different name in the next few days.
There is, and potentially we're going to get the name today. I think yesterday we were very close. The issue was with Matt Gaetz stepping aside, they had a deal with the Attorney General, so we had 2 AG nominations in 8 days, and we have yet to have 1 Treasury nomination since the election, and everyone is waiting for this. But as you said, the caliber of these names is so well known. Also, they're being backed by also big names. Steve Schwartzman for Bessent. Yesterday, Ken Griffin telling Shonali, Mark, please take the job, talking about Rowan. Mohammed Al-Arian coming on this program, talking about how he likes Kevin Warsh. So there's a lot of momentum going into this where whoever Donald Trump
I mentioned
selects.
this quote yesterday from Marko Kolanovic, formerly of JP Morgan. I think this is such an important quote. The issue in selecting a Treasury Secretary is not who can act changes, but who can best manage the market response and volatility that could undermine those changes. It's a big focus for all of us over the next few years. Coming up this hour, Ed Yardeni of Yardeni Research on the risk of higher inflation. We'll catch up with Dana Towsey of the Towsey Advisory Group as consumers prepare for holiday shopping. We'll speak to Tiffany Wilding of PIMCO on the odds of a December pause. We begin this hour with equities declining and bond yields falling. Ed Yardeni of Yardeni Research looking ahead to next year, writing a legitimate worry is that inflation expectations could rise, keeping long-term bond yields elevated and eroding confidence in the Federal Reserve. Ed joins us now for more. Ed, welcome to the program. Any sign in financial markets right now that that's developing?
Well, look, I think the Fed always is a key story here, and I think the key story is that the Fed officials still believe that the federal funds rate is restrictive and it needs to be lowered, and the last word we got on their median forecast of where the Fed funds rate should go to get us to nirvana is 2.9%. I think we're in nirvana now. I mean, correct me if I'm wrong, but isn't it nirvana to have an unemployment rate of about 4% and inflation at about 2%? So we're there, and I'm wondering whether they're just going to stimulate an economy that's already pretty hot.
Ed, you talked about the melt-up and the potential consequence if they keep stimulating a hot economy. We talked earlier with Cameron Dawson of New Edge, and she was saying that she sees 2 scenarios. One, a choppy path where you still see some gains in equities, or potentially a bubble of sorts really percolating up, and that's something that you've talked about. How much do you see that now as a more likely outcome, given the fact that you do believe there is stimulation into an already hot market?
Well, when the Fed lowered the Fed funds rate by 50 basis points on September 18th, we did actually increase the odds of a melt-up from 20% to 25%. We're still using 55% as the subjective probability for a roaring 2020 scenario. And the remaining 20%, I think I got it adding up to 100, but the remaining 20% is for geopolitical risk, debt risk, tariff risk. It's kind of a bucket for everything that could go wrong. But clearly, if the Fed keeps stimulating here, and again, with the economy doing quite well, that some of that liquidity is going to pour into the equity markets, and we're seeing that money market funds are up to $7 trillion. I mean, there's so much liquidity in the system, and for the Fed to say that the Fed funds rate's restrictive when the stock market's at an all-time record high, Bitcoin is at an all-time record high, real GDP is at an all-time record high. I mean, I'm scratching my head and said, what planet are they on?
At the same time, Ed, somebody could push back and say, sure, they're record highs, but this is an expanding economy, and frankly, the earnings have been outperforming quite considerably and show a lot of promise. We hear about the investment in artificial intelligence and data centers and energy. How do you sort of draw the line between a bubble and something that makes complete sense based on the growth?
Well, it's a totally subjective assessment, maybe not that much, because I think we can look at the charts and see where valuation multiples are. I mean, I'm really I wish Warren Buffett would tell us why he's raising so much cash. I think it's got everybody jittery. He's just doing it. And one of the explanations is that he's concerned that everything's too expensive and he doesn't see anything that's really worthwhile. And meanwhile, he sees that some of his assets are overvalued and he's raising cash. Now, he's the founder of the the Buffett ratio, which is basically the S&P 500 divided by S&P 500 revenues per share. And he was uncomfortable in the past when it got to 2.0. Well, it's 2.8. It's an all-time record high. On the other hand, a little less concerning is the PE, but not that much less because the forward PE currently is at 22. And back during the tech bubble of the late 1990s, it got up to 25. Tech and communications services accounts for 40% of the market cap of the S&P 500. The Mag 7 is about 30%. So, there's a lot of areas where valuation is stretched, but you're absolutely right. We're kind of rooting for I don't know what to call it other than a earnings-led melt-up. I hope that, and I do believe that earnings are going to be going surprisingly strong thanks to productivity, and that'll help a lot to keep the bull market going without stretching valuations further.
We talk about the sort of stock market being one barometer that President-elect Donald Trump will be looking at, and the bond market is the ultimate check. And I just wonder, at what point do you see bond yields starting to truly impede some of the euphoria that you're observing in equities?
Well, look, again, you can look at the charts, and back last year we had a mini debt crisis when the bond yield went from 4 to 5%. From August, September, and October, just in 3 months. And then we found lots of buyers at 5%. That's conceivable again, and we'll get everybody focused on the potential for a debt crisis. I think Trump actually bought some time on that because by setting up the Department of Government Efficiency with Elon and Vivek running it, we don't know whether they're going to really take the deficit problem and finally solve it to a certain extent.
Ed, we've seen task force like this in the past. You actually think they're going to be able to solve some of our fiscal debt issues?
Well, I didn't say they would do it. I said that Trump bought some time. I mean, we don't know for sure. Elon Musk, if you haven't read the book Elon Musk by Walter Isaacson, it's really a must-read, especially now. And he's got a great track record of cutting costs. He's obsessed with cutting costs. The only problem is it's one thing to do it in a company where you can hire and fire people and tell them what to do, whereas when it comes to the government, there's going to be a lot of political pushback.
Ed Yardeni, if you had any research, there might be some bond market pushback as well. Those bond vigilantes, that term you coined a long, long time ago, might make a big comeback, Lisa. That's a big focus for you, I know.
Yeah, although at the same time, and this is sort of the constraint, just to bring it back to the divergence between the U.S. and Europe, at what point does the pain in Europe cap yields in the U.S. because people are all going to be coming here for higher yields if yields keep going down? I mean, truly, it is sort of this question that we've been asking and exploring with the likes of Don Constam earlier.
There's certainly an argument for that, that's for sure. Let's get you an update on stories elsewhere just quickly with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. People familiar with the matter telling Bloomberg that JP Morgan is being investigated by the U.S. Treasury Department for its relationship with a hedge fund that is said to be part of a network overseen by an Iranian oil trader. The probe is still in the early stages while the agency examines if the firm complied with all rules and regulations. Spokespeople with JP Morgan, the U.S. Treasury, and the firm involved, Ocean Leonid, declined to comment. Meanwhile, Adani Group shares are rebounding, but this is after $27 billion of the conglomerate's market value was wiped off. U.S. prosecutors accused the founder, Gautam Adani, and other executives of allegedly plotting to bribe Indian government officials to secure solar energy contracts. The conglomerate has denied the allegations. And the euro falling to its lowest level in 2 years after euro area business activity unexpectedly shrank in November. The euro has since recovered a bit against the dollar, but still, traders are raising bets the ECB will cut 50 basis points to boost the region's economy. The euro is one of the worst performers of G10 currencies over the past 3 months as the risk of tariffs under the Trump administration remain prevalent. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next, the morning calls, plus Dana Telsey of the Telsey Advisory Group on the state of the consumer going into the holiday shopping season. That's up next.
We spent some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
The opening about 1 hour and 13 minutes away. Equity futures going into that look like this on the S&P 500. We're down by about 0.1%. Let's get you some morning calls. First up, Needham initiating coverage of Nike with a buy, saying the recent CEO transition is a positive catalyst. That stock is up by more than 1%. Your second call from JP Morgan, raising its price target on Ross Stores to 173, highlighting the company's favorable position heading into the holiday season. That stock is up by 7% this morning. And finally, Baird raising its price target on Gap to 29, pointing to another solid quarter. That stock is absolutely ripping. Let's stick with retail. 1 week out from Black Friday and a shortened holiday shopping season, Gap and Walmart seeing higher-end consumers coming to them for value as Target sees weakening sales and inventory piling up. Joining us now is Dana Telsey of Telsey Advisory Group. Dana, welcome to the program.
Thank you so much for having me.
Compare Target to everybody else. What went wrong there?
48% of Target sales are discretionary. They had elevated promotions, higher costs, didn't work. You look at Walmart, which has 60% of their sales coming from essentials. And when you think about discretionary, look what you just mentioned. The Gap is gaining some momentum right now. Look at TJX, same thing. They're gaining some momentum too. So that value shopper where there is style and product is working.
Is there an execution story there as well? What is the Gap doing right?
I think a couple things. I mean, Richard's phrase is perform while you transform. But one of the things they're doing right is the consistency of looking at the product and really elevating it today's times. Look at the wide leg denim jeans. They are remodeling some of their stores. At Old Navy, the kids' business is important. And the kids' business weakened in this quarter given the weather that was out there. Coming out of the quarter, kids strengthened. And so I think off-price value and where there's newness and innovation, consumers are going. So you have that in what's happening with the Gap brand and at Old Navy.
I want to get into policy and all of that, but what is newness and innovation right now? We talk about this. Is it launches? Is it limited edition? Is it wide leg pants that are going to be in style for, another 6 months maybe?
No, typically denim cycles can be 3 years.
Okay.
So they can be
Sorry,
a little bit
I take
longer.
it back.
No worries. But when you think about innovation, what's new and different? What about the closed-toed shoes at Birkenstock? Selling at full price, people are buying the sandals and they're buying the closed-toed shoes. When you think about the wide leg jeans, there's a lot in footwear. Look what Hoka's doing. With the new colorways at Hoka, it's interesting. Same thing at On. But you know what? You marry the product with the physical space. Look at the new remodels that are opening. If you walk lower Fifth Avenue, the new Gap remodel It's colors, it's got punch. You take a look at the Abercrombie remodel. They expanded the men's area. Look at the new On store. So we've got newness in product, newness in channel, and you need to have value.
Maybe Target just needs a new dog, and then they'll be just fine. But there is
There's
a
work
question.
to be done.
Okay. Meanwhile,
It's more than just the dog.
That's probably more than just the dog, given some of the performance. But there is this question about how exposed some of these retailers are to the potential of tariffs, especially if their whole rebirth depends on the ability for fast goods that they can get manufactured and brought in.
When we had tariffs the first time, everyone went to diversify their sourcing out of China. It's happening again now. Probably the one who's talked about it the most is Steve Madden, taking their percentage of goods from China down from 50% to 25%, hopefully in almost a year. Gap said it on their call last night, around less than 10% of their goods come from China. Where else are people going? They're going to Mexico, they're going to Africa, they're going to Vietnam in terms of where goods are going to be. The end result, though, and National Retail Federation talked about it, if we have these tariffs, you're going to have an impact to consumer spending that can approach nearly $80 billion. And what it requires in the apparel area, if you're going to have increased costs passed on to the consumer, can be price increases of low double digits. That's a concern across the board.
Are any of these retailers talking about coming back to the United States? Because what President-elect Trump is talking about is basically a carrot and stick approach. I'm putting up the walls, but you're going to get a 15%, potentially, corporate tax rate if you produce in USA.
No, some of them have mentioned some items coming back to the USA, but basically it's Mexico, it's Vietnam, it's even Africa where people are going. The labor costs are lower, they have the labor to be able to make the goods, and the expertise of it. That's why, the reason why everyone's in China, there is no China like China in terms of the expertise of how they make the goods. It will be a problem and a big topic of discussion throughout 25 if those tariffs get enacted.
Tariffs is one potential risk down the pipe. We also have the ports, that strikers. That deadline is January 15th. We see Target overshoot when they were building their inventory. Do you see retailers now having to build up inventory because they're concerned there won't be a deal in January?
I think overall they're watching carefully. Only Target has been the one who's called out the increased inventory that they're building. I don't really have others. As the earnings are being reported, you're still seeing inventory growth less than sales growth. Tuesday's a major day. You have all the mall retailers reporting on Tuesday in addition to Burlington. You got 10 reports coming out on Tuesday. We'll hear more, but what we've heard so far, I'm not seeing inventory pileups except for Target calling it out.
Why did they get it so wrong then?
The Target?
Yeah, how did they step on such a massive inventory landmine?
Different way of looking at things and how they're planning than everyone else. It is surprising in terms of how they stood out so much. Because when you look at Walmart, who reported just the day before, it was the other areas of business that also accelerated the growth.
When the numbers dropped, I think we all reflected on the same thing. It reminded us of spring 2022. This isn't the first time we've seen this movie, which I think is why some investors were pretty spooked by it. It's as if they haven't corrected for the mistakes they made a couple of years back. Is that a fair criticism of them, or is that unfair?
I think overall, they may have corrected then for the mistakes they made, but then looking at the macro landscape, they acted faster and made change quicker than others, while others basically are saying it takes time to enact some of these initiatives. And so, no, I'm not seeing others do that.
So you think they overcorrected based on the lesson that they learned in 22?
Yeah, it seems like it's way too advanced for what compared to everybody else. And you have to look at this holiday season. With a compressed season of 5 fewer days, promotions are happening. I don't know about your email inbox, but mine is filled with take percentage off.
How much does that 5 days change things?
Huge. I think the 5 days is very important. It makes the Black Friday weekend that much more important because there are fewer days. People always still shop the last 10 days before Christmas, but it's going to make the retailers hit the dial on let's ante up the promotions.
I wonder if Target is sort of a warning shot in terms of competing on more the innovation and less on just price. Value has to also come with something new. And I wonder how much Walmart is exerting that pressure because they can compete in a way that nobody else can because of their product mix. Is that the takeaway from some of the recent earnings?
Well, part of it, but also look what Walmart's doing. When Doug McMillon said that their highest growth came from some of their upper income consumers of $100,000 household income, they're taking that share from the Targets of the world. And you also have to say, look at the growth of TJX, the traffic increases that TJ is getting, and frankly, even some of the luxury items that they have, they're smattered about in just select stores, but it's a driver.
Well, is Gap basically copying that? Because they said yesterday that they're also making inroads with upper middle class, wealthy patrons.
But part of what Gap is doing, look at the collaborations to your mention before, whether it's influencers, whether it's Cult Gaia, they're getting in the conversation by stepping up and saying, we're part of the brand halo that's out there of other brands who want to be and reach a wider audience of consumers that have a wider income level.
Top pick this holiday shopping season. What is it?
Oh, I think on value, I think it's going to be TJX. That's the top pick there.
Okay.
When I think about newness, I think Birkenstock is going to continue to drive sales.
I can't stand them.
I don't know. I'm looking at the clogs now. I'm not too
them
sure.
and Crocs. I just cannot get on board with that.
I like
Do you?
Birkenstocks, yeah.
Do you?
I do. Tracks. Very much so. And like, yeah.
Doing your taxes in Birkenstocks?
Totally, absolutely.
Okay,
That's me.
all right.
Yep. I will out myself on that. I actually do think, they're very
How many
convenient.
pairs do you own?
I actually only own one.
With socks, because people wear them with
That,
socks. That's
I
weird.
think it's so specific, and it's such an era. I think it lasted less than 3 years, so the people who do it now.
That's done.
I think that is so
That has a
done.
3-year cycle too.
That has about a 2-month cycle. That is a no cycle.
Dana, appreciate your time. It's good to see you.
Thank you very much.
Busy few weeks of shopping ahead of us. Dana Towsey there of Towsey Advisory Group. Up next, Tiffany Wilding of PIMCO, Troy Gajewski of FS Investments from New York. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Equity futures on the S&P 500 just a little bit softer. We're down by not even 0.1% going into the opening bell. That cash opened 60 minutes away with your morning movers. Here's Manus Cranny. Hey, Manus.
Jonathan, a very good morning. Just to build on that conversation you just had with Dana there, we kick it off with Ross. Again, understanding the migration away from target, whether it's into other places, but you're going back to flat on this at the moment. This company's worth $47 billion. They're upping their guidance for the year. And again, the lower income customer is still feeling pressures. So that narrative about where the essentials, where do you go to buy your essentials and your discretionary items begins to split out. Roll it over, have a look at Gap. And I like what Dana had to say here. It's about capturing market share. You've got a number of issues, but look at this. We are up 21% at the moment, 4 consecutive quarters of sales growth. Richard Dickinson is doing something right in terms of product, in terms of merchandise, in terms of reinvigorating some of the brands, Old Navy and Athleta. So roll it over. By the way, they've only got a 10% exposure to China on the supply chains. I just thought we'd finish off with MicroStrategy. Yes, you've got a careering Bitcoin towards $100,000. This stock was down 16% yesterday and change. Why? Because the original evangelist behind this stock, which was Citron Research, actually they're shorting this stock. They say you've got ETFs, you can play Bitcoin in a multitude of ways. So they were an evangelist of the stock. They said it's the only way to invest, but they say the valuation on this stock is now becoming detached, perhaps from some of the reality. They say, if anything, use this as your hedge to short against your Bitcoin. Come on, 100,000, Jonathan. I can see you in the Crocs and the socks, just watching the Bitcoin tick, tick, tick.
I wish I had the Bitcoin. I don't know about the Crocs.
And the socks.
And the socks.
Definitely
and any of that stuff. Manus Cranny, you definitely don't do that either. Let's turn to the economy. Traders gearing up for a busy holiday week of data. FOMC minutes coming on Tuesday as the debate over a December skip continues. Tiffany Weinig of PIMCO writing, while recent stronger US data could have the Fed considering a pause in December and or adjusting its rate path higher in 2025, we think the broader trend is towards lower policy rates. I'm pleased to say that Tiffany joins us now for more. Tiffany, welcome to the program. Let's talk about that trend, why you believe the broader trend still holds and we're heading towards lower interest rates.
Yeah, well, I mean, I think if we just take a step back from, I mean, we obviously had a very big election event more recently, but if we just take a step back from that, and just take a look at where we've been over the last 4 years, we've been in a very unique period for global economies. The pandemic itself, the fiscal policies that supported it, the recovery from that, and we're actually getting back to normal. And you can see that if you look at overall inflation trends. In the U.S., we are still a little bit elevated on inflation, but we're in a stone's throw. Other economies, by the way, are much closer to normal in terms of inflation. And if you look at the labor market, it's also normalized quite a bit from those more acute labor shortages. We've had the unemployment rate up. So against that backdrop, central banks should also be moving towards some semblance of normal. And we think they have a lot of room here to continue to gradually reduce interest rates across a range of economic scenarios. So, although uncertainty, political uncertainty could slow that pace down, we think ultimately still there's a gradual pace down, and we view at least the prospect of hikes to still be relatively unlikely.
Well, let's park the hikes just for a moment. You said there's still a lot of room. So underpinning that statement, I assume that means neutral is a whole lot lower than where we are. Tiffany, how much lower do you think it is?
Well, we've argued that, neutral on a real basis is probably around 1%, around the developed markets, kind of a 0 to 1% range seems very reasonable to us. If you think about that in nominal terms, so adding inflation, if inflation's kind of 2 to 2.5, that suggests a 3 to 3.5% neutral nominal interest rate. and we think that's basically where they're going. And so that within that context, again, it seems like a gradual path lower is still very reasonable. Having said that, though, we do think they probably will adjust their forecast for 2025 somewhat higher. We're looking for 3.8 from them, and that's just because the economy's been doing well. So when the economy is strong, you don't have to lower interest rates as fast, but nevertheless, they want to make sure to stick that soft landing, and they don't want to overdo it. So again, that kind of gradual path lower still makes sense to us.
Tiffany, you talk about a neutral rate on average in developed markets. I wonder how much we could even talk about these averages anymore, given the fact that you are seeing this massive divergence between the U.S. and Europe, and the expected neutral rates are somewhat more different, at least according to some models, than that kind of range lets on. How are you thinking about that in terms of developed markets having a very different picture ex-U.S.?
Yeah, no, I think that's right. In Europe, excuse me, the models have suggested that other countries, including Europe, have had a lower neutral interest rate than the U.S. For some time now. So that, quote unquote, wedge there is not really anything new. It's why ultimately the ECB, in terms of the terminal rate on their hiking cycle, they got to a lower place than the U.S. So they've accounted for that to some extent. Nevertheless, when we look across the developed markets, we do see, more weakness, more underlying weakness, more kind of subpar growth in those markets than we have in the United States. But interestingly, though, inflation has come down a similar amount around the developed markets. And that's because the U.S., despite its stronger growth, has also had a stronger supply side response after the pandemic. We've been able to increase productivity much more than other developed markets. And that we've been very exceptional at that. And we've also been able to maintain some higher growth rates in investment, specifically R&D and research, IP type of investment that tends to continue those productivity trends. So I would say overall the U.S. is looking pretty good now versus everywhere else in the world. But again, nevertheless, as inflation has come down, it still gives room the Fed to to kind of get on that gradual easing path.
One thing that a number of our guests have been talking about is that the base case heading into next year of solid growth and a really expanding economy, but without inflation, remains the same after the election, but the tails are getting wider. That what you're seeing is a greater risk of both a real super acceleration or potentially a hit to growth from some of the policies. How do you look at things, given that there could be some pretty transformative policies put into place?
Yeah, I mean, so we would agree with that, that the tail risks on both sides of the distribution have gotten wider. I think there's going to be a lot of, I think as we go through 2025, we're going to get more certainty around the policy picture. You'll have the Tax Cuts and Jobs Act, which will have to be renegotiated. Many of those provisions will expire at the end of 2025. So Congress will be going through that process. We think there's some potential for them to legislate, some tariff hikes, maybe on China or try to do others within that. And of course, President Trump will be negotiating, and there's going to be a lot more trade policy uncertainty. So how all of those things impact the economy, is complex. I think the real question is do we have an increase, in business sentiment and confidence as a result of things like deregulation and more certainty, around the tax legislation, or do we have businesses that are maybe a little less confident because they're more uncertain about trade and trade policy and how that's going to shake out. And I think we'll just have to continue to monitor this as we go through the year next year to see which one of those effects is bigger.
Tiffany, which do you think is the more likely risk, the idea of a reacceleration in inflation or a bigger hit to growth?
Well, so we see the most likely for a more extreme reacceleration in inflation, of the type that we think might get the Fed to start thinking about rate hikes again. That kind of level of reacceleration, getting the core PCE rate back to 4.5%, that's historically more consistent with another supply side shock, an energy shock. And so that, the increasing geopolitical risks, for example, which drive energy prices higher, those would be the kinds of things that we would be looking for. I think in terms of the U.S. economy, certainly we are back to a better place in terms of demand versus supply. And so it would take, a lot more, domestic demand to really start to overheat the U.S. economy. So I think overall we're, in terms of inflation, I think we're still, pretty confident that we're getting into that 2-point-something zone. That is good news for the Fed. And then absent, a broader global supply shock, we expect, inflation to be around there. Then that doesn't say that it could be sticky a little bit above the target, certainly, but we think these pandemic-level inflation rates are still behind us at this point.
I'm going to ask you a really annoying question, so forgive me for finishing, Kit. Please forgive me. Is there a payrolls number that would change your view on December? And I don't think that's a judgment on you, really, Tiffany, at all. We just know how hyper-data dependent they've been at the Federal Reserve. Is there a number that you've got in mind that might change this conversation for December?
Yeah, so I think there's more, I think that the reaction to a lower number, a weaker number from the Fed might be a little bit more pronounced. So we had a noisy report in October. You had hurricanes that hit Florida. You had Boeing that had a strike. We will get some recovery in payrolls in November after those things have normalized. So the payroll report itself should be stronger as a result of that. So if we get a weaker report, there could be a bigger reaction. But I think at this point, if you get some rebound in strength, I'm not sure it moves the needle that much. I think on the other side, the unemployment rate, I think that will be, potentially a bigger swing factor. Surely if we get another 0.2 of an increase in the unemployment rate, like we did ahead of that September meeting, the Federal Reserve stands ready to react to that. They've been very clear that they're prepared to cut interest rates pretty quickly if they see a weakening, an unwanted weakening in the labor market.
Tiffany, you're one of the best. Appreciate your time, as always. Tiffany Welding there of PIMCO on the latest for the U.S. economy and the outlook for monetary policy. I'll keep going back to the calendar. December 6th for payrolls, December 11th for CPI, then a week later, the Federal Reserve.
I'll give you a number, 400K out.
Oh, yeah, 400K.
Yeah.
Very different.
300K, meh.
Did you find it interesting that I said, give me a number, and Tiffany started talking about weakness? The weakness would change the conversation the other way.
Right, but that's sort of really not where people's minds are right now.
Not
They're
at all.
looking at potentially if the unemployment rate drops back down or there is a sign of wage reacceleration, that could also do it. It's not just the employment number, as she was pointing out.
Let's cross over to Troy Gajewski of FS Investments. Troy, welcome to the program, buddy. Last time we caught up, you said it's not difficult to imagine what it would take to get higher yields from here. We've got higher yields. We're back at about 440 on 10s, 430 on 2s. Can you imagine higher yields from here?
Oh, 100%, John. I mean, when you look at the curve, it's still inverted from 10s minus Fed funds, which, as you know, is a very unusual circumstance. And as you think forward, what you were discussing before, as the Fed gradually brings the front end to 3 to 3.5, typically in expansionary periods, the 10-year minus Fed funds is 200 basis points, 300 basis points, sometimes even higher than that. And so just as you go through this cycle, it's very logical to see a 5% or higher 10-year. And that doesn't even address this tremendous supply-demand imbalance we're going to have. We're going to issue $20 trillion of treasuries the next 10 years, assuming we don't have another, major shock to the economy where the Treasury has to get much more aggressive at issuance. That's 73% of all the supply that's ever been issued that's owned by the public. Treasuries have the worst stock to flow of any major asset class. And then you think on the demand side, last I checked, the Fed is still tapering, right? They're still not only they're not buying, but they're reducing their ownership percentage. It's going to take a major shock to cause them to do QE anytime soon. The Chinese, even if we had a political solution to our difficulties, they don't have the current account surpluses to buy like they used to. So we just see a naturally steeping curve. And ironically, the faster the Fed cuts and the sooner they get to the lower end of that 3 to 3.5 range, the steeper the curve will probably get. So I just don't understand why people still talk up duration. At least you have hedge protection.
Yeah. But
in terms of attractive risk-reward profile, not terribly attractive.
So, Troy, certainly I'm not in a position to offer a forecast, but I can make a simple observation. We've come close to 450 a few times, and it's been bought every single time over the last few weeks. Is there any signal in that for you?
Yeah, so I think when you think of this major cycle we've gone through, right, we're in a 30-year plus bond bull market, but within that bull market, you had very wide ranges depending upon, whether in 2000, 2002, or GFC, or when the Fed unleashed QE. And the same goes for a bear market, right? You move from, a one handle on the 10-year. As you know, we briefly hit 5, but along the way, there are many ranges. So I think what more trading-oriented managers are doing, macro managers, for instance, as well as consultants, is trying to trade those ranges on the way back up, and so that can clearly provide support. I think it will take a few more Fed cuts to push the 10-year above 4.5% as we steepen further. And again, it's not that fixed income is the definition of return-free risk like it was at the end of 21, early 22. It's just hard to get excited about.
What's interesting to me is that right now you're not seeing yields at this level, sub 450, as constraining the equity rally in a material way. Do you see things differently? Do you think that it is, or that it will if it gets over 450?
Yeah, that's a great point. I mean, and I think that's also a function of where multiples are in markets at any given time, right? So, we reflated back up from 15.75 to a recent high of 22.6. Very, very expensive. If you look at the Russell, it's like up to 28 times forward earnings, which is borderline insane. So in a more, constrained valuation regime, there'd be less impact. But as you back up that curve, particularly for large and mega cap tech, it makes further multiple expansion very, very challenging. And we could have these mini repeats where higher yields are causing some degree of multiple compression, which has really been the case since the end of early 22. Most of the sell-offs in equity markets have not been caused by economic weakness, revenue weakness, earnings weakness. They've been caused by gapping higher yields like we had last October, for instance.
I have to say, Troy, I get that. And the PE ratios do look like they are extremely expensive, and the valuation argument definitely is coming up a lot. And then we hear things like what Tiffany Wilding was just saying from PIMCO, that productivity is getting better. What you see is that the equity is actually growing at a faster pace in certain industries than the price of the shares. I'm thinking of, say, NVIDIA, which is sort of the poster child of that. Why is that not a convincing argument to sort of put you off the concerns about valuation?
Oh, yeah. So, look, we've always said valuation is a terrible indicator of the short term, but it's a very good indicator of long-term performance. And investors should own U.S. market cap weighted indices. There's no doubt about it. I think locally, the question is, can we grow operating margins next year by 8%? And will there be a reacceleration in nominal GDP growth to lead to that, low teens type of earnings growth? That's going to be challenging. We're not knocking equities. We're just arguing that, the valuations at this point make further gains more challenging. And back in the day, you would complement that with international or small mid cap. But now, because you have so many more choices and alternatives like middle market private equity, where you have roughly half the valuation on enterprise value EBITDA that you do on the Russell, and you're enjoying 13% revenue growth, there's better choices in your asset allocation as you fade some of that recent strength, or you don't allocate more into an overweight position to U.S. equities already. Because most investors have been driven to overweight U.S. equities by just the tremendous performance you've seen. But you're going to get revenue growth, you're going to get earnings growth, operating margin expansion is a question, and you just have to be more realistic about what the forward return forecasts are.
Sure. I'd love to turn to the politics. A lot of this was priced in terms of what Trump plans to do. The Trump trade was already priced in. But what can you see as material impact from Trump and potentially what he might do in 2025 that's not priced in right now into the equity market?
Yeah, great question. So what we've been waiting for on the more liquid side of our business is for merger arb to come back, right? It's been a very challenging period. There's been a lot of government intervention. That being said, even during peak intervention, only 8% of deals were breaking versus 5% long-term average. So, when you think forward, our view is that, mega cap is going to continue to be challenged for acquisitions, right? That mega cap tech. There's going to be continued political pressure to block those deals. However, in other industries where there are logical mergers, like airlines, for instance, those will more than likely be allowed to go through. So mergers should not necessarily boom, but come back very strong. And then I think just as important long-term for the health of private markets is the IPO market's not going back to 2021 anytime soon, but you will see much healthier IPO activity. And those are both also very good for private credit, because a lot of the financing opportunities we're seeing now are financing upcoming mergers as well as, potential acquisitions. So without corporate capital activity, it gets much harder to generate attractive returns in certain strategies. So we're very optimistic that that is not priced in, like, for instance, in banks, where you don't see Wells Fargo up 13% every day. There's still some pockets of opportunity in non-correlated strategies.
Final word, Troy. Pick a Treasury Secretary. Got a name in mind?
Morris is really interesting because it's contrary to, the Trump, we love easy money policy, right? Yeah. But it does seem like there's a consensus forming around him. And it is really interesting. You guys have done great reporting on this, the natural evolution from Treasury Secretary to potential Fed chair over time. We don't have a preferred candidate, but it seems like he's been gaining steam, as you know.
The reporting is all Anne-Marie. It's nothing to do with me. Troy, appreciate your time, sir. Thank you, buddy. Troy Gajewski of FS Investments with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Citadel founder Ken Griffin said he would consider selling a minority stake of the $65 billion hedge fund. Speaking with Bloomberg at the Economic Club of New York yesterday, Griffin said he would consider selling to a firm similar to Sequoia Capital. He said, quote, "That's going to push us to be better at what we do in our business day in and day out." Meanwhile, Bitcoin is closing in on $100,000, driven by expectations of friendly U.S. regulations and growing investor interest. We're currently trading around $97,500 this coming as President-elect Donald Trump's transition team has already held discussions over whether to create a new White House post dedicated to digital asset policy. The crypto market has gained about $1 trillion since the U.S. presidential election. And Apple is working on making Siri more conversational. According to people familiar, the goal is to catch up with OpenAI's ChatGPT and other chatbots that are better able to hold ongoing conversations and respond more quickly. In order to do this, Apple plans to use more advanced large language models. The company is currently planning to release the new Siri as early as spring 2026. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. Have a wonderful weekend. Up next on the program, setting you up for the day ahead. You're watching Bloomberg TV.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Live from New York City, 36 minutes opening bell. Here's the trading diary through the next week or so. The calendar looks like this. Today we get S&P global PMIs and UMich consumer sentiment. Look out for the political breakdown of consumer confidence. That's always one to enjoy. Tuesday, consumer confidence, new home sales and Fed minutes. Wednesday, durable goods and a second GDP read and another round of jobless claims before we get the US holiday, Thanksgiving. All eyes, of course, on Mar-a-Lago before we get there this weekend. But Donald Trump's search for Treasury Secretary. The list is about 4 people deep. We know the names pretty well. Will we get a decision this weekend?
We potentially get a decision as soon as today. You know, the thinking was this would come yesterday, and Greg Valliere talks about this morning. The fact that the messy Gates departure has 2 major implications for Trump. One of them being it stalled the delivery of this Treasury Secretary that we've been talking about for days. Wall Street Journal this morning picking up on our reporting earlier in the week that potentially there is a duo at play, 3D chess. You pick Kevin Warsh for Treasury before he goes over to the Fed in 2016. Bessent goes to NEC before then he becomes Treasury Secretary maybe in 2016. But we need to remember, this is not over yet. And Scott Bessent has the support of, I was listening to Steve Bannon yesterday in the War Room, and Steve Schwartzman. It's a pretty big swath of people that's backing him.
I'm going shopping. I think
you're going to Gap?
Yeah, I'm going to go check out the new styles at Gap, the new releases. So I'm going to go check out, the retail spirit in America.
Just take a deep breath. It's only been a little more than 2 weeks since the election. All 4 names are of a very high caliber. Let's wait and see what we get.
It's the holiday season that's starting out, and so we can focus on other things too.
No, we got 2 AGs in 8 days, and we have not had a Treasury pick.
You're in a rush. I'm not sensing the same thing on this pick. They've got to get this right. Coming up on Monday, Mike Data of Roth Partners, David Bianco of DWS, Mike Wilson of Morgan Stanley, Francis Donald of RBC from New York City. Thank you for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
God.
All right, thank God, it is Friday, and we may actually have a Treasury pick 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and Bloomberg Open Interest starts right now.
Coming up, we are poised for PMIs. S&P futures are pairing losses ahead of U.S. manufacturing and services data. It's out later this hour, and we're going to do everything we can to make it exciting. The retail value play Gap and Ross stores see strong results as wealthier shoppers hunt for deals. And President-elect Trump names a new pick for Attorney General as the search for a Treasury Secretary drags on and on and on and on. We don't even care anymore.
Maybe today, though.
Let's take a look at where the market's trading. We could get it today. And Anne-Marie Horton does care, so we're going to talk to her about it. S&P futures, you can see, are off, but really that's unchanged. The same is actually true of NASDAQ 100 futures, down 0.2%. The 10-year yield also little changed, off 2 basis points at 439.82. So we need something to move these markets today. Or it's Friday. You could just chill.
Maybe we can all just go home. That would certainly be nice. But let's take a look at Gap right now, because it's absolutely soaring pre-market right now. That's after it reported an increase in wealthier shoppers, rather. It also raised its full-year outlook. That's good for a 19% surge. We'll see if that holds. Let's also talk about Intuit. It's lower right now after the maker of TurboTax, it's a tax reporter. Its results fell short of analysts' estimates. You can see shares currently down about 2%. And then we strain our eyes on Alphabet. Not a huge move here, but it is a little bit lower on a report that OpenAI is considering developing a web browser that would be bad news for Google. A little bit of bad news for the stock right now. Alphabet shares down about 0.8%, Matt.
And maybe bad news for Intuit. I love to talk about taxes next to AI, because you should be using, hopefully we could be using artificial intelligence to do our taxes.
Yeah, can't the robots do my taxes? That seems like a natural application.
Right, but the problem is I don't even think the IRS understands the rules. So how could we train a computer? Let's talk about returns for a second, Katie. Come back over here. Come back over to the desk, and let's just chat quickly about the S&P 500 versus the MSCI World ex-US Index versus bonds. Really, the question that you posed yesterday when we were on Bloomberg Radio and television together is, why even bother trying to diversify? Because if you just put your money in the S&P, or I guess in the Qs, stocks basically in America, you're going to outperform everything else.
It's pretty amazing. I mean, looking at that chart, the S&P 500 in amber there, orange, it makes me want to play eagle noises and maybe get some American flags, because you think about the might of the U.S. stock market. It's pretty amazing. And this is, of course, a one-year snapshot, but it goes back in time, too. And that conversation we were having about hedge funds why you bother with hedge funds. I get it. You want to diversify. Occasionally, the line does go down, but very rarely, Matt.
Should we ask Andrew Sliman?
Yeah, why not?
Let's bring him in. Morgan Stanley Investment Management Senior Portfolio Manager Andrew Sliman joins us, and I'm sure, you know, in good times, Andrew, your clients must be asking you this all the time. Why do I bother hedging? Why do I bother diversifying? Why can't we just put all my money in a stocks fund that beats everybody else anyway? What do you say?
Bring it on, Matt. That's what I say. Bring it on. I love it. But I do think, look, there's a couple things going on here is that, you know, yesterday you saw the equal-weighted S&P start to outperform the cap-weighted. And that's because of some government, you know, incursions into these big companies. And so there is an opportunity to move down the cap curve that's starting to appear, and that will help stock picking over, you know, just pure S&P 500, you know, kind of indexing.
Well, we've had this conversation before about how difficult it is to be a stock picker if your benchmark is the S&P 500. Well, let's talk about that a little bit. Talk to us about how active your active share has to be right now.
Well, you know, look, I'm an active manager, and we've had a great last couple of years, and it's because of high active share. You can outperform and not own just the Mag 7, but I think what is happening now is you're getting a bifurcation of the Mag 7 where not all are working, and that will help stock picking as you move down the cap curve. It's easier to be overweight smaller companies that are in the S&P, and therefore your active share goes up. But I think what's really most important to consider here, Katie, is normally when you come out of a bear market like we had in 2022, small caps outperform, equal-weighted outperforms a cap-weighted, but it didn't happen this time. And I think the key difference is normally when you're coming out of a bear market, the Fed is cutting rates, and they didn't start cutting or announce they were cutting until July. And it was at the July juncture when the equal-weighted started to at least stay in line with the cap-weighted S&P.
Well, Andrew, you started down one of my favorite topics, and that is where you are when it comes to size. We were having this conversation with a portfolio manager from Goldman Sachs yesterday, actually, that you take a look at pure play active small cap managers, they've actually been cheating up. And like you mentioned, typically you go down the size scale to maybe find some extra alpha there. It seems like you're saying that there's a return to that more normal dynamic where you actually look into the smaller areas of the market to find those opportunities.
I think so, but I haven't been in that camp for a long time because I'm just trying to outperform, and I could see that the size factor was outperforming from really the October 22 low, but that is starting to change. So as that changed, that frees up the opportunity to move down the cap curve and start to pick away at some smaller companies, at least for what I do in the S&P. But for a smaller cap, I think smaller cap will outperform. Look, animal spirits are coming back to the market. People are talking about, oh, financials are working, value's working, and that's true. But go look at how the darlings of the 2021 roaring bull market and big growth are doing. These are not, it's not just Tesla and MicroStrategy. There are a lot of these go-go growth stocks. They have taken off since that July cut. So I think the stock picking is going to be more speculative in nature, and that means stocks other than just buying the Mag 7.
Andrew, if we back out and just look at the index, you know, the cap-weighted index here, we hit 6,000 and overcame that for a brief moment. We dropped back down, but it looks like we're heading back towards 6,000 at 59.48. When Trump comes into office, when we start to get more certainty on policy, I mean, is there really still reason to be bullish into 2025?
Well, it's still November, Matt, and so we got another month, and then we have until Inauguration Day, 3 weeks. And I think I just have a hard time seeing any substantive pullback in the market till after the inauguration. We're in the honeymoon period for any president. And then once they start to put pen to paper and you realize that not everything's, perfect, that's when the market tends to pull back. So I just don't see much of a pullback in the market until at least, kind of February. So yeah, I think markets tend to rally between, now and January, about 75% of the time, I think people are still looking for ways to invest. If I talk to our wealth management advisors, they are telling me that the same clients that told them they didn't want equities 2 years ago, even though they're still in equities, they want more equities now. So it is a more speculative time in the market, and I don't see a pullback in that until after Inauguration Day.
Are there certain industry groups that you think are best poised to outperform? I mean, I know, typically in the last quarter, the market rallies, I think, more than 4% on average. In January, since we did tax loss harvesting in December, we go back and buy the stocks, and that gooses the index a little bit. But are there pockets that you think are better than others in terms of that Santa Claus rally and the January effect?
Well, look, I think if I look at opportunities, financials, I love financials. We have a big weighting financial worth as biggest overweight, but they've gone through the roof. And so to stand here today and say, Matt, you got to buy, money center banks and the asset manager, I think that's a really hard thing to do at this juncture. So what has not participated? One thing I think is the bond market is very oversold. Yields have gone up on this expectation that deficit's going to go through the roof. It's all spend. If there's any relief in the bond market, I think some of the areas that have lagged, like the home builders, I think they would come back strong, or REITs. So the opportunity that has not participated, but I think would if the bond market would calm down, would be the interest-sensitive areas. I think that's an intriguing opportunity as I sit here right today.
All right, Andrew, that's a good place to leave it. Always great to speak with you. Have a great weekend when you get there. That is Andrew Sliman of Morgan Stanley Investment Management. And Andrew did remind us that it's only November. But to the question that you asked, there was an interesting DataTrek note out this morning. I'm sure you've heard of DataTrek.
Yes, of course.
Nick Kolas posed the question, how will the S&P 500 perform in 2025? The easy answer is up 10%. That has been its average price return since 1928, which kind of ties back to that chart. Why bother with anything else?
Yeah, because I think his argument is the third year of a bull market, and he looks back at the historical performance. But of course, we have it's different this time coming up in 2025 with President Trump in the Oval Office for the second term.
It's similar to what we already got, but it's different this time. And of course, this is a very expensive market. We'll keep that conversation going, but let's get a look at what's moving underneath the surface right now. You can see the S&P 500, it's very quiet. So too are the NASDAQ 100 and the Russell 2000. So to take a look at some of the stocks moving ahead of the opening bell, here's Abigail Doolittle.
Well, one stock that's moved into the top 100 stocks for the S&P 500 because of its meteoric rise this year, MicroStrategy, today up 1%. Earlier, it had been up a bit more, but this after falling more than 16% yesterday, the worst day since August. At the lows yesterday, the worst day since, I believe it was 2022. This, of course, as Andrew Leff put out a short report basically recommending a pairs trade, long Bitcoin, but use MicroStrategy and its principal position in Bitcoin as a bit of a hedge. But today, the stock recovering a little bit of that loss. Turning to the shares of Elastic, you can see they are soaring up 23%. The software company put up a great quarter. The analysts are saying points of stabilization. They also raised the view. And then finally, speaking of raising the view, NetApp, the storage company, also higher, up 7.6%. One analyst calling the quarter flawless, investors liking it, and you can see that on lifting the view as well as that great quarter, the stock up almost 8%, Matt.
All right, Abigail, thanks very much. Abigail Doolittle talking to us about some of the individual movers ahead of the opening bell. We still have about 18 minutes to go. Coming up, Matt Gaetz is out as Pam Bondi becomes the president-elect's new pick for Attorney General. All the details next, and I'm sure we'll get into some kind of conversation about whether or not Trump is going to pick a Treasury Secretary.
It's coming.
This is Bloomberg.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Who is the Vivian Tom clientele? Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Earnings season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell.
Earnings from Caesars crossing the Bloomberg terminal. Mondelez is reporting
Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate, when your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Let's get now to high interest and look at what's making headlines around the world. Euro area business activity unexpectedly fell in November, leading traders to ramp up bets that the ECB will continue easing. Manufacturing slipped deeper into recession, while services saw a steep deterioration. The euro weakened to its lowest level against the dollar since 2022. The U.S. is examining J.P. Morgan's ties to an Iranian oil trader. The Treasury Department is probing the bank's relationship with the hedge fund Ocean Leonid Investments. Last month, Bloomberg reported that the fund was part of a network overseen by Hossein Shamkhani, the son of a prominent advisor to the Iranian supreme leader. No comment from J.P. Morgan, Ocean Leonid Investments, or the U.S. Treasury Department. And DirecTV has called off its takeover of Dish after it failed to win the consent of bondholders for a key debt exchange. Dish has not initiated fresh discussions. The merger would have created the largest U.S. pay TV provider, with DirecTV assuming $9.75 billion of debt. Katie?
All right, well, that leads nicely into your favorite topic, and that is the fact that we are still awaiting President-elect Donald Trump's pick for Treasury Secretary. The Wall Street Journal reporting that Trump is considering former Fed Governor Kevin Warsh for the role. We've been talking about him for a few days, so let's get more now from Bloomberg Surveillance co-host Anne-Marie Hordern, and that's half of it, right? He's considering Warsh for Treasury Secretary and then maybe Fed Chair.
Yeah, so this could potentially be musical chairs when it comes to Treasury and the Fed and NEC. And we've been reporting on this before the Wall Street Journal, by the way, came out with their front page story today, that one idea that individuals around Trump potentially liked, because everyone knows that Kevin Warsh actually wants to be the Fed chair, is that you put him at Treasury till 2026 when Powell's term expires, and you put Scott Bessent at NEC. And then in 2026, everyone moves Treasury to Fed for Warsh, and then West Wing to Treasury for Scott Bessent. But I would still say the decision is not made, and potentially we're going to get the decision today. And what we've seen in the past 24 hours is the likes of Steve Bannon on War Room coming out and saying from the very beginning, We thought a safe pair of hands is Scott Bessent as Secretary of Treasury.
Yeah.
What I would say is Scott Bessent at that moment, and amongst all these people, has the support of the base, of MAGA, those senators. So, and like the likes of Steve Bannon,
So why
as well
bother?
as Steve Schwartzman. So yes, there is this idea that maybe it could be Warsh at Treasury, Bessent at NEC. I'm just going to say we don't know yet. And there's been a lot of momentum in the past 24 hours behind Scott Bessent as well, who's been there since the beginning.
I just don't understand why bother with the musical chairs. Why not just put Bessent at the Treasury from the start? If you want Warsh at the Fed, you can hold him at NEC. I mean, is this all just because Lutnick got together with Elon Musk to try and stab him in the back?
Sort of. It became really this very tense situation with the transition. Howard Lutnick wanted this job. It then became a very much so a two-man race between Scott Bessent and Howard Lutnick. And to diffuse it, they brought in these other names. And then Howard was given a job. Mr. Lutnick will be going over to the Commerce Secretary. And if you look at that press release, he's actually getting an expanded role when it comes to the idea of trade and tariffs. That press release, even though I'm not quite sure how that's going to actually work given the legality of it, but it said that USTR would be reporting up to him. I think the signal there is that this is going to be Trump's guy when it comes to going on TV, talking about negotiations, what it means for trade. So that either leaves, the tension has either dissipated and Scott Bessent could rise to the top of the Treasury, or potentially there is going to be this off-ramp where everyone is happy and you could have maybe a Warsh at Treasury, Bessent at NEC, or there's still dark horse, Mark Rowan. What did we hear yesterday with Ken Griffin sitting down with Shinali saying, Mark, please take this job? And then Senator Haggerty as well has been floated for a number of cabinet positions. Could be someone that pretty much everyone agrees on.
So you talk about Mark Rowan as a dark horse, but you think about the Matt Gaetz experience, and we'll get to Matt Gaetz, but Matt Gaetz being named for Attorney General, no one was expecting that. Is it possible that the names that we're talking about, that we could get a true dark horse and it's someone that we haven't even had on our radar?
Well, given how we've seen other names fill nominations for cabinet positions, 100% yes. But this is really important to the president, and he seems to be spending a lot of time with these individuals. We're going to get, I think, an announcement as soon as today. Of course, it could be someone we're not discussing, but that would be definitely something out of left field, definitely a dark horse. But you mentioned Matt Gaetz, 2 attorney general nominations in 8 days.
Oof.
Because the votes were just not there for that man.
Yeah, it's amazing that that was only 8 days because it feels like so much longer, but maybe as soon as today for Treasury Secretary, you have a busy couple of days ahead of you. That, of course, is
busy weekend, Anne Marie.
Busy weekend, no days off.
She's used to it.
Anne Marie Hordern, of course, Bloomberg Surveillance co-host. Let's bring you some breaking news really quickly here, and that is that Amazon is investing an additional $4 billion in AI firm Anthropic, boosting its stake in the OpenAI rival. The cloud computing giant pumping this in. This is according to a statement that Amazon put out. You can see Amazon shares rising a little bit right now, Matt, up about 0.7% here.
Yeah, it's interesting how much money is needed to train these models, right? You've got to sink a ton of it right now into NVIDIA chipsets and servers and, as we know, plumbers and concrete people.
We learned all of this, of course, at Bloomberg Intelligence's fantastic AI conference this week.
It was really good.
It was really good. And just to bring you that headline again, Amazon, another $4 billion in Anthropic. We'll discuss all of it and what's going on in the market up next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins.
We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
All right, welcome back to Bloomberg Open Interest. We're taking a look at futures right now. You can see the S&P 500, it's pretty quiet, down about 0.1%. We will end this week on a positive note unless something amazing happens between 9:30 and 4 p.m. today. You take a look at the NASDAQ 100, down about 0.3%, even though you do have Amazon moving a little bit higher right now on that breaking news that it will invest an additional $4 billion in Anthropic. That's an OpenAI rival. And then you take a look at the Russell 2000, the small caps resplendent right now. The Russell 2000 up about 0.3% pre-market, outperforming once again, Matt Miller. You have to ask the question, of course, how much juice is left in this trade, and are interest rates coming down to support it?
Yeah, I don't know about small caps.
Yeah.
That's really your realm. I do know that this is the Amazon headline is the kind of thing that could wake up some animal spirits. And if you look at on the terminal, most U4 is the function used to see the pre-market movers filter out for only companies that are worth more than $50 billion. Because I don't bother with Russell 2000. You see, Dell is up 3%, Snowflake is up 2%, Salesforce is up 1%. So these kind of AI adjacent stocks are starting to move a little bit higher. I note the Dow Jones Industrial Average is back up over 44,000.
Oh, come on.
So
you pay attention to the Dow pre-market,
yeah,
but
because
not the
if
Russell
I type
2000?
WEI go on the Bloomberg terminal, the home screen for stocks shows me first the Dow Jones Industrial Average, then the S&P 500, and then it starts to go into like Brazilian stocks.
Yeah, I need to send some emails about that. I feel like the Russell 2000 deserves a little bit more respect. But in any case, coming up, we'll take you to the opening bell and take a look at all the stocks that are making moves. This is Bloomberg.
The leader in technology for as long as you have been. Do you think AI is just as landscape changing as everyone else seems to think it is?
Sometimes things are overhyped. I don't think that AI is overhyped.
I think Etsy's uniquely positioned to benefit from AI. Finding that needle in the haystack is tricky. That's part of what makes Etsy both delightful and frustrating to people. And being able to serve the good stuff to the top fastest is where AI can really benefit us.
Our mission is keeping commerce human, and actually we talk about AI as helping us to be superhuman. It's really the partnership between AI and humans that makes Etsy work.
AI can help Etsy's customers personalize their searches and steer shoppers more directly to items they may want to buy. It's also helped the company improve reliability by predicting delivery times more precisely. But that doesn't solve a larger challenge, getting more consumers to think of Etsy more often and ultimately become repeat buyers. To this end, Etsy invented gift mode.
Getting in the top of mind consideration when you're thinking, I have a gift, I'm going to go to Etsy, just getting that to be more habitual. Gift mode provides a perfect opportunity for that. We get to know the gifter, but we also get to know the recipient. So it's a way to, sort of a more viral way to bring in more, introduce more people to Etsy.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
All right, we're moments away from the start of trading on this Friday and starting to see a little bit more movement in these indexes. Here you can see the S&P 500 futures still unchanged. NASDAQ futures down about 0.2%. But under the hood, I'm telling you, some of the individual movers are shifting after the headline from Amazon that they'll invest another $4 billion in Anthropic. You hear the opening bell at the NASDAQ and the New York Stock Exchange. If you look down at the NYSE, you're going to see UGP. So this company is a Brazilian holding company that moves gas and chemicals around and stores them. Actually celebrating its 25th anniversary at the New York Stock Exchange, but its stock is down 40% year to date and 40% over the last 5 years. So it really hasn't done well. Hopefully this will be the boost they need. Thumbs up. At the NASDAQ market site, I think it's some kind of social media thing where they basically bribe customers to like their posts. I'm not accusing anyone of bribery, but I think you get paid over Venmo or PayPal if you like the posts, something like that. I'm too old to understand this sort of thing. Katie, please save me in terms of thumbs up.
I'm not going to try to explain it. Let's talk about the stock market because we're about 50 seconds into this trading session. On this Friday, it's the end of the week, and you can see it's a pretty, at least quiet for right now and to the week. The S&P 500 up slightly, emphasis on slightly. The NASDAQ 100 down slightly. It's been an interesting week. We will end with gains, but not enough to offset what we saw the week before, down about 2% on the S&P 500 last week, up about 1.3%. at the moment. Then you take a look at the small caps, of course. The little guys really leading the market over the past couple months. That is the dynamic, as you can see today as well. The Russell 2000 up about 0.3%. But let's peek under the hood. Might explain some of the weakness that we're seeing in the big tech index. TurboTax maker Intuit. It's lower. That's after it missed its analyst estimates. Investors disappointed by the company's new AI products. You can see that disappointment in the shares right now. And breaking just a couple minutes ago, Amazon says it will invest an additional $4 billion into the open AI rival Anthropic. AWS will become Anthropic's primary training partner for its AI models. Traders trying to decide what to do with this news. The stock was higher by about 0.7%, now back to unchanged, Matt.
Got to spend money to make money, Katie. Amazon knows that more than anybody else. Gap, the clothing store, higher after boosting its annual sales forecast. For a deeper dive into the retail sector, we go over to Bloomberg's Abigail Doolittle. Abby, what do you got?
Well, let's start off with Gap because it's really pretty interesting. And there's similarities between the Gap and Walmart, if you can believe it. Gap really had a great quarter and the outlook looking good because apparently wealthier consumers, higher income consumers going to the Gap stores, the various Gap stores, Old Navy, Banana Republic, and Athleta, and of course the namesake Gap, for value. You can see the stock absolutely soaring over the last 2 days, up 22%. So yesterday up about 6%. It seems as though some folks knew about that quarter. Let's take a look at what investors really like, though, and that's the fact that they boosted the guide, the old guide for the full fiscal year, less than 1%. That could be anywhere from 0.1% to 0.9%. The new range, the high end, 2%, 1.5 to 2%. So not big numbers, but going in a better direction than it had been. But let's broaden it out to retail. It was also Ross Stores has put up a good quarter, better than feared. Some are saying the outlook has stabilized, up 5.4% on the week. There's Walmart, that good quarter again, and boosted the view on the higher income consumer going there for value. These are 1 week views. And then Target, on the other hand, or Target, I should say, because that Target feeling clearly not there, down 19.4%, dismal quarter, missed estimates in a big way, slashed the view. And then Lowe's, they also had a little bit of a tough time. So we still have this bifurcated consumer. And it seems we also have tales between different retail stores where some are operating better and some a little bit less well, Katie.
It is just stunning to see that move in Target. Like you said, maybe they should get back more of those Target vibes, but in any case, down 19% in a single week. Abigail Doolittle, thank you. And let's broaden out this conversation now with Marianne Bartels. She is Sanctuary Wealth Chief Investment Strategist, joining us now. And Marianne, going straight to this line in your notes that we are estimating the S&P 500 at 10,000 to 13,000. That's a return of 70% to 100% before we see a peak in the market. For context, we're just below 6,000 right now. When you think about some of those big numbers, what kind of time frame are we talking about?
So that's not my forecast for next year.
Okay.
Let's be clear. We still believe we're in a secular bull market. And I don't think this secular bull is going to peak out until 2029, 2030. And I do think we can get to 10,000. I remember when it was big when the Dow hit 10,000. And I do think in this cycle before we peak, we can get to 10,000 on the S&P 500. Now, for next year, my forecast is still very bullish. I'm at 7,200 to 7,400. I like to have a range. And so why am I so bullish? I do believe that this technology of artificial intelligence and blockchain is going to be transformative, not just to our economy, but to global economies. And we went back, and there's a lot of talk about the mid to late 1990s, like 95 to 2000. And we did find a lot of parallels that are similar. We also went back to the 20s and looked at 1925 to the peak in 29. We also found a lot of similarities. So the theme of our year ahead report was all that's new is old. We have had technological transformations before. It created a very strong economy, created strong corporate profits that really surged equity prices. And I think we're right in that sweet spot right now.
So I wonder, Marianne, I always think of you as a technical analyst. I think that's what you're famous for, but you studied economics, you're talking fundamentals. How much of this is fundamentals versus technicals?
It's really a blend. It's 50-50. I spent many years as a quant, and I always want to be a strategist, so here I am. I'm blending everything together. And what I found is when the fundamentals and the technicals match, I have very high conviction, and I think that's what we have. I do believe the technicals get to this level. It's certainly hard to do projections for earnings going out the next 5 years, but the technicals actually get you there. So you have to back in and say, well, how are we going to get there? Well, we have AI and we have blockchain, and we haven't even really talked about blockchain and the transformation that that technology can have on our economy and our markets. So again, the technicals, fundamentals, I think they're all aligned. Tech is still the leader. In fact, when we looked at the return on equity, the return on equity for the tech sector is 31% compared to the S&P. The earnings are coming out of these tech companies. So I know there's high valuations, but they're supported by earnings.
So that's really fascinating. I want to dig into the fundamentals a little bit more. It sounds like you're saying it's tech that leads us there. What happens to the rest of the market, though, on this march to 10,000 potentially?
It's all tides lift everything. So I think the whole market will generally come up. One of the things that we're optimistic on is maybe small cap can actually perk up here. I don't think they're sustainable leadership, but we have good seasonalities. They are less expensive. So I do think over the next 12 months, you're going to continue to get a broadening out. I think small cap can play a very big role in that. Infrastructure is very big. We need infrastructure build out to have AI. That's the industrials. The sectors that really look sick to me are healthcare and consumer staples. I'm really not seeing anything in those sectors at all. Eventually, maybe utilities, but as long as the back end of the curve, the 10-year remains elevated, it'll struggle for utilities as a sector. But those utility companies like Vistra and Constellation are doing phenomenally well in this market.
You mentioned blockchain. Katie doesn't want to talk about it. I have to bring it up.
I have an open mind. Let's go.
Well, look, you can't deny that the Bitcoin trade, first of all, XBT currency. It always kind of makes me giggle when I put currency because I no longer think of it that way. But the Bitcoin rally has been insane. We were up to 99,500 and change today. We're back down a little on Bitcoin. This is an interesting chart that Dan Curtis put together out of London. It just shows that the smaller, higher risk coins have traded up faster than Bitcoin over the last couple of weeks. But the rise of Bitcoin is undeniable, Marianne. What do you see in this, $100,000 token?
So we did see earlier this year, we did project 100,000. We're up there. Now, typically when we get to important big round numbers in markets, you can struggle a little bit to get some backing and filling, but we do think we'll break through. The first technical target, once it breaks 100, will be 113 and then 150. So I'm not doing the very long-term projections because you can easily do that based on supply and demand. There's only supposed to be 21 million Bitcoin printed. We have 8 billion people in the world. You can do the math just that way.
Do you own it, Marianne? Do you own Bitcoin?
I do.
Good for you.
For full disclosure, I do, and there are other tokens I also own. I became fascinated with crypto after I retired from Merrill Lynch and Bank of America. I always felt that Bitcoin, that there was something there. I'm a big Trekkie fan, and I really believe that we were moving to a digital world for currency. And I think Bitcoin, I don't know if Bitcoin will be that currency, but I believe that it's symbolic of that we're moving to an electronic form of having a currency.
Marianne, let me just for disclosure, I'm not like a crypto hater, and I do think it's useful. You mentioned the technicals. I have to imagine for a technician, that's a dream asset class. And it's a really interesting measure of risk appetite. Marianne, great to speak with you as always. That is Marianne Bartels of Sanctuary Wealth. I know that you're a big crypto guy.
I mean, I have loved it from day one. Just the kind of the community around it, the libertarian bent.
Yeah.
I like these kind of fun Reddit-based conspiracy theory things, and Bitcoin falls into that for me. Also because of the reasons that Marianne said, I find it interesting, but because I'm a journalist, unfortunately, I did not ever make a big investment in it, so I don't own any.
Well, the good news is that you didn't, and you get to work here at Bloomberg News. Coming up, retail stocks getting a boost ahead of the holiday shopping season. We'll discuss who's hot and who's not next. This is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that, have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Piper Sandler says the solar energy company Sunrun is no longer a buy and cuts its recommendation to neutral. The analyst says that the company may need to cut costs and increase prices if the Trump administration alters subsidies in the Inflation Reduction Act. Next up, Raymond James is cutting HCA Healthcare along with Tenet Healthcare and Community Health Systems, citing potential headwinds ahead for the group. The analyst says that there will be a likely reduction in the Affordable Care Act exchange population because of sunsetting of subsidies in 2026. And finally, we have Needham initiating coverage of Crocs with a buy rating and a $116 price target. The firm says that the stock has been overly punished in recent months and says that he's encouraged by the company's talent investments this year. Crocs tapped former Yeezy shoe designer Stephen Smith as its new head of innovation earlier this week, Matt.
Yeezy. All right, we got PMIs out, and on the services side, in composite side, they're better than expected. I buy a lot. We were looking for 55 on services PMIs, and we got 57, so that line continues to climb. If we pull up Dan Curtis's chart, you'll see that services continues to increase. Manufacturing, on the other hand, getting a little bit better than the previous forecast, the previous print, but a little bit worse than the forecast at 48.8. It does continue to climb. I guess this chart hasn't updated yet because you'll see the blue line jump higher and the white line will edge a little bit higher.
Would the white line be above the yellow line?
No, not yet. And that indicates that we're still in a contractionary period in terms of manufacturing. Above the yellow line is expansion. The interesting thing will be to see if the next Trump administration or the sort of post-election time period really moves those numbers significantly. It certainly looks to have done so in services.
Yeah, absolutely. Hopefully we'll get an updated chart on that soon, but a really interesting dichotomy still in our economy that it's all about services, not as much about manufacturing, though you do see a little bit of a recovery there. Let's talk about retailers, though, because two retailers in particular have a reason to feel optimistic ahead of the holiday season. Gap and Ross stores both higher this morning after reporting their latest results. Let's break it all down with Emily Cohn. She is Bloomberg Consumer Editor. It feels like for Ross stores, it was a better than feared sort of vibe, whereas for Gap, there's a real recovery and some real excitement there.
Yeah, I think we're seeing this continued story that we've seen all week of this. There are two different consumers that we're talking about here, right? On Gap, they're seeing gains share gains from the middle and upper income shoppers. Households that are making more than $100,000 a year are trading down to Gap and Old Navy where they know they can find value. We heard almost the same exact thing from Walmart this week, and it led to huge share gains there. Interestingly, we're also seeing other share gains this morning from retailers like Urban Outfitters and Abercrombie and Fitch are both up with Gap. On Ross, this is a different consumer we're talking about, right? This is a discount retailer, and we're seeing other discount retailers like Burlington up this morning. So again, this speaks to this bifurcated consumer where we see the wealthier consumers trading down for value. And on the other end of the spectrum, we see some higher end retailers where consumers are seeing more bang for their buck and value pop. This is what we saw earlier this week when Target reported its down report. We saw Williams-Sonoma and Happier News pop. So we're seeing this bifurcated consumer where people are really trading down for value.
And I mean, you know, Ross hasn't had a fantastic year. It's up, I think, 7% and change year to date. Gap is up a little over 13% year to date. Neither one of them really keeping up with the huge gains at Walmart. Is that just a story of scale, or is it something to do with the consumers that are going to these other two stores?
Yeah, I mean, Walmart just has this advantage of having everything. So a lot of the things that when people are feeling pinched, they're prioritizing essentials, right? Like you have to buy groceries. Groceries represent 60% of business at Walmart. So even when people are trading down, they're still buying essentials. They're still going to Walmart. And I think we saw a winner there this week with Walmart doing much better than Target in that event.
Yeah, big time. A big winner in Walmart, a big loser in Target. Target down about 19% for the week. That's going to leave a mark. Emily Cohn, great to speak with you. Have a great weekend. Now,
Thanks,
coming
you
up,
too.
Ken Griffin makes his case against tariffs at the Economic Club of New York. Highlight from our interview with him next in today's Wall Street Beat. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Citadel CEO Ken Griffin making his case against tariffs. He spoke with Bloomberg's Shonali Basak, our co-anchor at the Economic Club of New York.
I am gravely concerned that the rise of tariffs
puts us on a slippery slope towards cronyism capital. So when you implement tariffs for the American companies that produce goods in America, there's unquestionably a short-term benefit. You've just taken your competitors and severely disadvantaged them. The challenge with this, and we know this from the history of economics, those same companies that enjoy that momentary sugar rush of having their competitors removed from the battlefield soon become complacent, soon take for granted their newfound economic superiority, and frankly, they become less competitive on both the world stage and less competitive at meeting the needs of the American consumer. And then, of course, once you're in this world where companies know that their very existence is because of tariffs, in other words, if the tariffs came down, they wouldn't be able to compete, they wouldn't be able to thrive. Now you're going to find the halls of Washington really filled with the special interest groups and the lobbyists as people look for continued higher and higher tariffs to keep away foreign competition and to protect inefficient American businesses that fail to meet the needs of the American consumer.
Are you concerned here that some companies, some industries will be benefiting at the expense of others, even in this country?
Well, of course that's true, right? Those companies that bring in goods from around the world will be disadvantaged out of the gate. Those companies with a very large domestic production base will be advantaged out of the gate. I'm not so worried about I should be more worried about it, to be blunt. I haven't given much thought to sort of the internal equity as between these parties in the United States. I'm much more concerned that this is the beginning of a slippery slope towards economic, both irrelevance and going back to the earliest point, a decline in productivity, a decline in the very important need that we have to increase American productivity.
That was Citadel CEO Ken Griffin and Bloomberg Sonali Basak in a wide-ranging and I thought really fantastic interview. Griffin was very forthcoming about his thoughts, both positive and negative, on the Trump administration.
Yeah.
But I thought it was interesting that he's worried about a slide into crony capitalism, as if we're not already there.
That's true. That is a good point there. And I mean, he makes a very thoughtful, nuanced argument against tariffs, why we should maybe proceed with caution there. I don't know if anyone in the incoming administration is necessarily listening to that, though. You know, these arguments against tariffs, you know that Trump calls
himself... It's a beautiful word.
Tariff man, I believe.
Yeah.
So we'll see. He also, of course, said that he would be open to selling a stake in Citadel. That is the $65 billion multi-strategy hedge fund.
That was fascinating.
That was very interesting. We saw something similar from Millennium, for example, and clearly Ken Griffin is thinking about it, too.
Yeah, Millennium with BlackRock, and he was praising Izzy Englander and Larry Fink.
Yeah, he spent a lot of time doing that.
For what they've built, but I really thought his explanation about why multi-strat hedge funds have kind of seen their day was really interesting as well. Just a great piece to go back and look at. I think you might have to join the Economic Club of New York to actually see the full thing.
Yeah, I'm not quite sure. But in any case, let's take a look at these markets right now. It's a Friday. It's been a busy week, and you can see we're still getting a little bit of a lift when it comes to the S&P 500, up about 0.3%. Can't exactly say the same yet for the NASDAQ 100, but stay tuned. We have a double dose of CEOs coming up in the next hour. We'll speak to the CEO of Manulife and Shark Ninja. That's coming up. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. More severe weather is expected to slam Northern California after hundreds of people got stuck in rapidly rising floodwaters this week.
Some 300 people became temporarily trapped inside a hospital and hotel in Santa Rosa. This after the North San Francisco Bay Area received a foot of rain in 48 hours.
Driving in the rain is something that I really don't like to do.
Trevor is trying to see the silver lining in the storm system.
It's going to be good for us because we need the rain.
Meanwhile, residents are preparing for a second wave of heavy rain and high winds. Sarah Henry with the city of Alameda says they continue to make sandbags available.
So it's 5 per person, and hopefully people adhere to that because we want to make sure we have enough for everybody.
Matt Bigler for CBS News, Alameda, California.
Thanksgiving is 6 days away, and airlines are bracing. Correspondent Chris Van Cleve is at LAX.
The TSA expects Wednesday and the Sunday after Thanksgiving to be the busiest days at airports. Sunday likely tops 3 million passing through checkpoints and could set a new record.
President-elect Donald Trump's hoping his second choice to lead the Justice Department, former Florida Attorney General Pam Bondi, will have an easier time winning confirmation than his first, Matt Gaetz. Correspondent Ed O'Keefe says Bondi is
someone who, when she was Florida Attorney General, sued to block or curtail the scope of the Affordable Care Act, has done other conservative legal work like that, both when she was Attorney General and in the years since.
Gaetz bowed out amid fears he wouldn't be confirmed over allegations of sexual misconduct. The Kremlin says a strike in Ukraine using a new hypersonic ballistic missile was a warning to the West. Vladimir Putin spokesman Dmitry Peskov through an interpreter.
The main message is that the reckless decisions and actions of Western countries that produce missiles, supply them to Ukraine, and subsequently take part in conducting strikes on Russian territory cannot remain without a reaction from the Russian side.
A couple of funeral home owners in Colorado are expected to plead guilty today. CBS's Jim Krasula.
John and Carrie Holford face more than 200 counts of corpse abuse. Prosecutors say the owners of the Return to Nature funeral home began improperly storing bodies in a building outside Colorado Springs as far back as 2019. They also allege the couple gave grieving families dry concrete in place of their loved ones' cremains.
Scary news for people with asthma. U.S. government researchers say widely prescribed Singulair inhalers may be linked to serious mental health problems. They found the drug attaches to brain receptors critical to psychiatric functioning. There have been thousands of reports of neuropsychiatric episodes, including suicides. Dow is up 324 points. This is CBS News. Dozens of casino workers have been arrested on the Strip.
At a protest outside Virgin Hotels Las Vegas, police arrested 57 casino workers out on the picket line. Members blocked a road in front of the hotel while holding signs, chanting, and marching in solidarity. Hundreds of workers walked off their jobs last week over stalled contract talks. The culinary union said its president was among those arrested. Stacey Lynn, CBS News.
New review finds dozens of the country's largest retailers jacked up interest rates on store-branded credit cards to record highs in the months before the Fed began cutting rates. Data collected by Bankrate shows Gap, Petco, Burlington, Macy's, TJ Maxx, all among at least 50, out to pad profits during a stretch of sluggish sales. Biggest offender? Bankrupt Big Lots. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Brokers Studio in New York City. To our worldwide audience, are streaming live on YouTube. This is the Bloomberg Intelligence Program. Alex Steele, Paul Sweeney with you. Coming up today, Mission. Some economic data coming out of the University of Michigan. We'll break it down. Joanne Shu, she's from the Wolverine State. She'll break it down for us. We're going to get a sense of what's going on out there in the stock market, a little red and green. David Powell, senior Euro-era economist for Bloomberg Economics, talked to us on some of the economic data coming out of Europe, a little bit weaker than expected on their PMIs there, so we're going to break that down. Grace Lee, senior portfolio manager at Columbia Threadneedle, discuss her outlook for the markets here. So we got a lot coming up in this hour. Right now, let's kick it off. Elise Mateo and a Bloomberg Business Flash.
You got it. This Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around the clock. All right, we do have more economic data out this morning. We'll start with S&P Global U.S. Manufacturing PMI. The expectation for November was 48.9, came in just a tick lower at 48.8. Then we get to U.S. Global Services PMI. The expectation was for 55, came in a little bit higher at 57. We go to University of Michigan sentiment. It dipped down just a bit. The expectation was for 73.9, came in at 71.8. Keep in mind that's sentiment taking place after the election. Paul and Alex are going to break that down in just a bit. Let's head to the stock market. We have the NASDAQ. Little change, down about 3 points. We have the Dow up 0.6%, 272 points. The S&P 500 up 0.2%, or 15 points. We have the 2-year yield, 4.35%. That's little change. The yield on the 10-year, 4.5%. 1.41%, and that's down 1 basis point. To currencies, the dollar on course for an 8th straight weekly advance. Right now, the Bloomberg Dollar Spot Index up 0.3%. We have the euro dropping to its weakest level since 2022. The euro at 104.14 against a dollar, down about 0.5%. British pound weaker. Bitcoin slightly lower, down about 0.2%, but still just over 97,000. To earnings we go. Shares of Gap, that's the owner of Old Navy, Athleta, those shares up about 8%, raised its full-year sales outlook. It's attracting wealthier shoppers that are just looking to save a couple bucks. And speaking of value, shares of discount retailer Ross Stores, they're up about 3%, listed its annual projections for earnings per share. And finally, shares of Intuit, the maker of TurboTax, you know them, those shares down 4% after its forecast fell short of estimates. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's the Bloomberg Business Flash. Paul and Alex.
All right. Thanks so much, Lisa. I'm Alex Steele alongside Paul Sweeney. Happy Friday. Everyone made it to the end of the week.
Yes.
We did that.
Yep.
Lots to go through over the next couple hours. We want to kick off with more on that UMich sentiment. It is the final read for November, but I'm interested to see sort of what that brings in when it comes to the election results. So Joanne Shu, University of Michigan Surveys of Consumer Director, joins us. Sentiment coming in at about 73.9, a little bit better. Current conditions, 64.4, also better. Expectations, also a touch better. Does this encapsulate the election?
Yes, it does. So our preliminary read that we released 2 weeks ago did not encapsulate the election, but today's release includes 2 weeks before and 2 weeks after the election. Essentially what we saw was that after Trump was elected, sentiment lost about half of the gains that it had seen in the first 2 weeks of the month. But on net, we're still a little bit better than we were in October, and we are now at 4 straight months of incremental gains.
Joanne, talk to us about inflation outlook. I know you guys at Michigan take a look at that in your survey. How are people thinking about the inflation outlook?
In the short run, people are expecting inflation to continue stabilizing. We saw the year ahead inflation expectations edge down by 0.1%, likely supported by lower gas prices at this time of year. That being said, we actually saw long-run inflation expectations go from 3.0 to 3.2. That's kind of on the high side of the range we've been seeing for the last couple of years. Consumers are perceiving quite a bit of uncertainty over long-run inflation, which is consistent with the fact that we don't really know exactly what Trump's economic agenda is going to look like over the next 4 years. So that uncertainty seems quite reasonable.
All right, Joanne, thank you so much. We appreciate it. Appreciate getting a couple minutes of your time. Joanne Shu, she's at the University of Michigan. Surveys of Consumer. She directs to that whole business here. And again, the UMich survey number, just the headline number, I'm going to go with that. It came in at 71.8, consensus was 73.9, and also was down a little bit from last period as well, but still in pretty solid territory. Let's get a sense of what's happening out there in the markets. We got some red, we got some green, but there's some stories underneath the hood. Natalia Kinyajevic joins us. She's an equities reporter for Bloomberg News. She joins us here in our studio. But before we get to you,
Wait. Yeah, you go, and then
I'm going to do something important. Market Drivers today is brought to you by IBKR. With Interactive Brokers Forecast Trader, you can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today.
Did he do it? Did you say your last name?
That's perfect.
You did it. So, like,
so stressed
my month away worked for
yes,
you.
Exactly.
You were forced to. Okay.
Exactly. Natalia, what are you looking at?
Let's start with Gap, guys. So we see the shares are rising. The company boosted its forecast, and analysts are saying that the company sees more sales across consumers that earn more than $100,000 per year. I would like to highlight specifically Old Navy because this accounts for 55% of company's revenues, and analysts really highlighted a great job of its CEO, who is a former CEO of Mattel. And he made a huge transformation. So basically, they said on a cultural level, but also in terms of savings, in terms of execution, everything is going pretty well. And Old Navy, they also brought Zach Posen. You see that brand is changing. They attract more customers. They sell collaborations really quickly. And really, it's gaining momentum, that brand. And Bloomberg Intelligence made a really interesting survey. Old Navy was named as #1 brand, guys, across consumers who make below $100,000. So,
really?
Yeah.
That's quite interesting.
And there's another survey from Bloomberg Intelligence shows that brands like Amazon, Walmart, Nike, and Old Navy will be among retailers that will benefit the most next year from Gen Z and millennials who are planning to spend almost 2 times more than they spent in 2023.
Wow,
so
that like genuinely surprises me, and I put money on the fact that Paul's not been inside at Old Navy.
No.
Yeah,
Yes.
I win.
Yeah.
All right, what else are you watching?
Yeah, another one, also consumer story, Ross sales. Shares are up, but we saw some weakness in third quarter, but that was mainly driven by weather. It was warmer than expected, and of course, hurricanes. So this is not a company-specific, of course,
But this
issue.
is also when weather counts, because usually retailers blame weather, you roll your eyes, but like they have 35% of their sales in Florida and California. It's like it's real. This is a real weather issue.
It is, and also preliminary traffic for this quarter already shows that it's picking up, so probably the next quarter will be even better. And of course, the company's strategy overall, they're trying to bring more expensive brands, and they give really good, I don't know how big, do you like shopping? Do you guys talk about shopping here?
Please, how long have you known me? Don't insult my intelligence. Duh.
Yeah, so yeah, they give really good discounts and deals for customers who like brands like Michael Kors, Juicy Couture, and that is why the company is doing pretty well.
Good. All right. Anything else out there?
Positioning, guys. I would like to highlight one little thing. So we
Yep.
spoke a lot about small caps, and we see that, of course, rally is losing its steam again because of high yields. This is a macro story, but in terms of positioning, we see that some traders are positioned for really big drawdowns across equity market, and this is driven by, again, positioning for high yields. So it's kind of chicken and egg story, but we potentially can see more declines in small cap stocks.
All right, Natalia, thanks a lot. We really appreciate it. Natalia Knežević joining us from Bloomberg News. Let's get to the other big news of the day, and that was European PMIs. They were terrible.
Yep.
And you definitely then saw re-rating in terms of cuts, maybe a 50 basis point cut from the ECB. So we wanted to break it down a little bit more for you with David Powell, senior Euro area economist for Bloomberg Economics. David, what was so bad about these numbers? What stood out to you?
Well, actually, they were bad all around, and that's really what stood out. There was no bright spots here. So the composite figure for the euro area declined, and the numbers for both the services and manufacturing sectors were weak. In addition to that, we get a national breakdown with the first release, which shows the numbers for France and Germany, and it showed both of the euro area's 2 largest economies experience weakness. So it's not something that's just isolated to one country or one sector. It's this broad-based weakness.
Again, it's interesting that we woke up to this data here in the States, David, and we kind of said we knew there was, it was softer across Europe, but some of this data came in and just really, I think, surprised the markets here. What's the expectation for the next, 6 to 12 months as it relates to European economic activity?
Well, I think the market is bracing for a deterioration in the economic numbers coming out of the euro area, and that's because of the electoral victory of Donald Trump. One of his campaign promises was to impose tariffs not only on China but smaller tariffs on other trading partners. And one country that really stands out on that list is Germany, given its huge trade surplus with the United States, and it's a country that Donald Trump specifically referred to on many occasions during the campaign. And we have run the numbers, and our estimate is if those tariffs turn out to be as high as Trump promised during the campaign, that could knock in the short term about 1% off of GDP in the euro area. And we've also had estimates come from the Bundesbank, Germany's central bank, and they have a similar estimate for the German economy. And that's going to be a big shock to demand in the euro area, which will require the ECB in all likelihood to respond in the form of lower interest rates.
Right.
And that comes on top of what was already a weak economy before any of this happened.
Okay, so do you think 50 basis points coming up?
I don't think they'll cut by 50 basis points in December. It will certainly introduce that topic for discussion. I think the more likely outcome is you just see a longer period of 25 basis point cuts. So we look for a cut of 25 basis points in December, and we think the ECB will keep with these back-to-back cuts, meaning cut at every meeting until they reach neutral, which is about 2%. So we're going to have numerous cuts coming up throughout the start of 2025. And like I said, more frequent cuts is more likely than larger cuts.
David, thank you so much for joining us. We appreciate getting a few minutes of your time. David Powell, he's a senior Euro area economist for Bloomberg Economics, joining us from London via Zoom thing. I mean, I'm looking at the euro here. I mean, we're almost at parity here, 1.04. I mean, I'm thinking of Tom Keene, booking the reservations in Paris and in Rome. He's going to get a good deal.
I mean, that's why he's not here today, right?
That's why he's not. That's right. He hopped on a quick flight.
But we're at the lowest level since 2022.
Right.
And that's been helped, obviously, by the dollar strength. So it's a twofold story.
Yep.
But I also just wonder, what would a 50 basis point cut, for example, actually materially do? There's some things like fiscal spend that you just cannot compete when it comes to the U.S. at the end of the day.
This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn more about your consultative support and technology. All right, so we've got a mixed start to the trading day. Investors still trying to shrug off initial concerns. They could be NVIDIA's revenue outlook. NVIDIA shares still down about 2% right now. Let's head over to stocks. NASDAQ down 0.1%, 31 points. We have the Dow up 0.4%, 230. down 13 points. The S&P 500 up 0.1% or 6 points. Bank of America actually warning that the NASDAQ 100 approaching a level could trigger a shift away from U.S. equities and toward international stocks. As far as the bond market, the 2-year yield 4.36%. That's little change. The yield on the 10-year 4.42%, and that is little change. The Bloomberg Dollar Spot Index up 0.3%. We have the Japanese yen, euro, British pound weaker. Over to commodities, gold headed for its biggest weekly gain in 13 months. I'll point out spot gold up more than 1% at $2,696 an ounce. And oil, Brent crude up nearly 0.5% at $74 a barrel. WTI crude $70 a barrel. Few companies making news. Amazon, it says it will invest an additional $4 billion into the OpenAI rival Anthropic. AWS will become Anthropic's primary training partner for its AI models. And Ken Griffin said he'll be open to selling a piece of Citadel. It happened during an interview with Bloomberg. He said he would consider a partner like Sequoia Capital and also ruled out an IPO. And finally, your interaction with Siri could get a little more conversational. Apple is saying it'll use more advanced large language models to allow for back and forth dialogue. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash.
All right, Lisa, does that mean that they're going to understand what I say? That Siri will understand me?
I don't know, but I yell at Siri, so I don't think it'll be a good conversation.
No. Also, but sometimes, you know, at least for Echo, Echo doesn't respond to me unless I yell at it.
Oh.
Like,
that's not good.
No, like unless I'm trying to be nice and like it doesn't actually do what I say unless I yell. Like what is that lesson I'm teaching my child?
I don't know.
Anyway, this is Bloomberg Intelligence. Happy Friday. I'm Alex Steele alongside Lisa Mateo and Paul Sweeney. So NVIDIA was billed as like the biggest event for the end of the year. And so my question over the last 24 hours has been, okay, well, we're done with that. So then what? And I keep getting notes in my inbox about how the rally is broadening out. And then I hear, ooh, we might be topping out in tech. Go diversify. So let's get someone whose job is to actually understand all this. Grace Lee, Senior Portfolio Manager for Columbia Threadneedle, joins us now. Grace, what is the right strategy now that we're done with NVIDIA? Now what?
Well, I think we always have to pay attention to NVIDIA. And I think what NVIDIA's earnings showed us this week is that the AI theme is still alive and well. And so, so I think we can't ignore that. But that said, there are plenty of other sectors, and I think we're starting to see that. You know, we've started to see it all year. You know, you've seen a stealth rally in utilities and banks, especially post-elections. You know, there has been definitely a people taking a second look at financials and other sectors that might have been a little bit more ignored during the year because of maybe regulatory concerns and things, which have certainly eased post-elections.
Grace, what did the election mean to you and your team when you woke up that Wednesday morning? Did it alter your outlook or how you're thinking about asset allocation or sectors? How did you think about that?
You know, I think mostly it was a huge clearing event, that it was decisive. It didn't take days or weeks to count the votes or anything. And then I think that it really is probably more of a positive, I think, for the markets. The one takeaway I would say is that at this point, I probably don't want to be more defensive. You know, I think business leaders, company managements that we've met with since the elections, they are more optimistic about what might happen under a Trump administration and with a Republican Congress.
What are your favorite top companies right now? Let's give me a couple that really float your boat.
Well, I think in terms of, I would broaden it out to maybe some sectors. I think, you know, I would say utilities is actually an interesting one. As much as I say don't get more defensive, there are some actual secular themes going on in the utility sector. And by utilities, I'm not talking, certainly the power producers have done very well this year. But, you know, when you think of plain vanilla regulated utilities, I would say that if there's ever a time to get excited about these companies, now is that time. And, you know, these are companies like Xcel Energy, Southern Company, the ones that maybe your, you know, grandmother might have been clipping the dividends. But at this point, what we've seen is that we've had flat power demand for probably over 20 years. And that is now changing for the next several years, where it's not just AI data centers, it's just broader electrification. EVs, crypto mining, and reshoring that's going to drive a lot more power demand, which means that the regulated utilities will have to invest, and that means that their earnings growth ticks up higher. And we've started seeing that in reality this quarter, where you've seen some really interesting stock reactions, maybe even double-digit price gains in a day off of just slightly higher long-term earnings outlooks. And I think that can continue within the sector.
Right. Hey, Grace, as a former banker, when I woke up that Wednesday morning, I said, M&A. I think that could be back on the front burner here. The regulators have been really, really tough on M&A over the last several years. That might change. Does that factor into how you think about what sectors to get exposure to?
I think broadly, M&A should pick up. People have been waiting for this for a long time. I think, financials are obviously front and center there. We're certainly involved in some of the capital market stocks, some of the alternative investment managers, which we think we will certainly see benefits there. I think broadly and possibly, we don't traffic in small caps a ton, but I think some of the smaller mid-cap companies might also be a little bit more interesting in this environment as potential targets.
Yeah, and profitable small cap. That's really been outperforming.
Exactly.
All right. Thanks so much, Grace. Really appreciate it. Grace Lee, Senior Portfolio Manager for Columbia Threadneedle, joining us. Another story that we're following today concerns oil and JP Morgan and Iran. So apparently the U.S. Treasury Department is examining JP Morgan's relationship with a hedge fund that is said to be part of a network that's overseen by Iranian oil trader Hossein Shamkhani. We want to understand sort of more on this. What might this violate in terms of sanctions or not? So here to break it down for us is Elliot Stein, Bloomberg Intelligence litigation analyst. Can you just give us the facts first?
Yeah, so, the investigation's early, the reporting is early, a lot of unknowns, both known and unknown at this point. But it sounds like the Treasury Department is investigating JP Morgan in relation to its connection to this hedge fund that's based in London and Dubai, and the hedge fund's connection to an oil trader. And it sounds like the overall investigation is focused on the oil trader, but the Treasury Department's also looking at JP Morgan to make sure that it followed its due diligence and did its KYC and know your customer and AML compliance processes.
And I guess I'm just looking at the Bloomberg reporting. I guess if folks there say JP Morgan feels like they don't need to do anything here because neither the Shamkhani guy nor the company appear in any sanctions list, I guess.
Right, yeah, and this may be a nothing burger. There may be nothing there. Best case scenario, or one possible scenario where JP Morgan has no exposure, is that maybe it did all its due diligence and it was misled by the companies it was doing its due diligence on. That's just one possibility. But worst case scenario, it didn't do its due diligence, or it ignored red flags, and we've seen, recently with TD Bank, what that can amount to.
So if this oil trader did have a relationship with this individual from Iran, what does that potentially violate? What are the sanctions and the rules currently that would make that a problem?
Right, so, banks should not be doing business with companies that are under sanctions or on, special lists. And so it's unclear what the connection is, though, to this oil trader. Apparently, he is the son of someone who was in the Ayatollah's inner circle. So there may be some connections. But we've seen in the past that banks have paid billions of dollars for doing transactions with the Iranian government or other Iranian entities that are on sanctions lists. So it can be very costly. But it's not clear that the investigation is even focused on that. It may be sort of just to make sure that JP Morgan was doing its due diligence.
And doing through the training here at Bloomberg about this type of issues. This is exactly the type of training that
the same thing.
We receive, and I'm sure everybody across the industry to various degrees receives about, hey, if you're doing business with somebody that may or may not be on a list, just stop. Call your boss, call compliance, see what the gig is before you move forward.
Well, it sounds like this could be like a third derivative.
Yeah.
Exactly, and that's why there's a lot of unknowns here. The bank may have no exposure, but anytime you're talking about sanctions on Iran and banks doing transactions, indirectly as well, your eyebrows get raised, and banks have paid a lot of money in the past for failures related to this.
Do we feel that sanctions could get more strenuous under President Trump? Like, what are you thinking about?
Certainly possible, right? I mean, yeah, I would expect that. I would expect that.
All right, so I'm looking at JP Morgan stocks up 1% today, up 45% year to date. So I'm assuming the market's discounting this as a non-risk issue. How about other litigation that you're working? What else are you working on? Because you do the litigation that companies have to deal with. That can move stocks.
Absolutely. And actually, in this arena, there are several other banks that are under investigation for either AML violations or potentially sanctions violations. UBS is being investigated in connection with clients that took over from Credit Suisse, who may be in violation of sanctions on Russia. There's a Swedish bank, Swedbank, that has been under investigation for AML violations for years now, so I'm waiting for a penalty there. There's a Turkish bank, Halkbank, that was indicted by the U.S. government for violating sanctions on Iran. So that's one area I'm looking at. Another big area right now is all these rules and regulations that the SEC and other regulators have put into place under the Biden administration. There's a lot of lawsuits over them, and so we're waiting to see what's going to happen with the rules and with the lawsuits.
What else would a Trump victory mean for your world?
Right, so in connection with these rules and regulations that the SEC has promulgated during the Biden administration, and the CFPB as well, we're expecting a lot of the rules and regulations to maybe be paused in terms of enforcing them, and then the regulators will probably go back and revisit the rules, but that takes a while. I'm also, I'm attuned to the courts as well, and I'm particularly interested in seeing whether the two oldest justices on the Supreme Court, Clarence Thomas and Sam Alito, retire probably at some point during this next Trump administration. Right? In which case he would name the replacements, and you'll have a conservative majority for at least another generation on the Supreme Court.
Interesting. Because you started off fine going to Stanford, then you went to get a law degree.
I got a law
degree. It all turned south, man. What were you thinking?
Have you marked your calendar for the Stanford-Duke basketball game?
No, because we're now in the same conference, right?
Yeah.
When is that?
I don't have it on my calendar,
right,
but I think it's in January, maybe February.
All right, we'll check it out. Because Stanford is in the Atlantic Coast Conference. That makes sense.
Yeah, big game this weekend.
My Duke field hockey team had a little problem getting out to the Bay Area for their games against Stanford. Because you're in Durham. You have to transfer and connect. And I'm like, why are my kids going out to San Francisco? It's just, the whole thing's a mess. Elliot Stein, Bloomberg Intelligence litigation analyst, joining us here in our Bloomberg Interactive broker studio. Markets, S&P, absolutely unched on the day. Got a little lift to the Dow. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Big tech's grip on U.S. stocks, well, it could loosen a bit further. Bloomberg Intelligence says it'll happen as underachieving segments of the S&P 500 start fundamentally catching up. So basically, they say equities, well, they may need a bigger boat. Always love a good Jaws reference. Over to stocks right now. The NASDAQ, little change, up about 4 points. The Dow up 0.5%, 225 points. The S&P 500 up 0.2% or 14 points. We have the 2-year yield, 4.37%. That's up 2 basis points. The yield on the 10-year, 4.42%, and that is little change. To currencies, we have the Bloomberg Dollar Spot Index up 0.3%. Japanese yen, euro, British pound weaker, and we have Bitcoin at just over 98,000. Shares of Reddit, well, they're down about 7%. Sources say shareholder Advance Magazine Publishers, they plan to borrow against its $1.2 billion Reddit stake. And another portfolio change for Honeywell. It's agreed to sell its PPE unit. That's in a $1.3 billion cash deal. The thing is, it comes as activist investor Elliott Investment Management, well, they've been pressuring the company to break apart. Honeywell is up about 1%. And finally, sources say DirecTV will call off its planned acquisition of Dish after bondholders rejected that debt exchange. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash.
All right, thanks so much, Lisa Mateo. Alex Deal alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. Bitcoin, we are nearing the $100,000 mark. I don't know what happens with that. We get confetti, we get balloons, I don't know, something. Right. Dan Curtis, our massively awesome guy who does all the data for us here at Bloomberg TV, he said, fun fact, it took 11 months for Bitcoin to go up tenfold from $1,000 to $10,000, but if it crosses the level today, it took 7 years for the next 10 times increase. But we might get there. We might get there. Mike McGlone is Bloomberg Intelligence Senior Commodity Strategist, and he joins us now. Do we cross it? Do we cross the Rubicon today?
Today, I don't know, but Alex, it's a matter of time. You got to get that print. It did it in futures, but the actual Bitcoin, I mean, just for the headlines, I think some of the whales are trying to do it. But the signs of I'm worried about the signs of speculative excesses. Now you get those in all bull markets, but this one, the extremes are so silly. So for instance, the key thing I've been watching for over a decade is that Bitcoin versus gold ratio. It's right now 36.5 ounces of gold per 1 point Bitcoin. That's still below the high from 2021, around 37. So it's holding that resistance. And what we're seeing, what happened in MicroStrategy. MicroStrategy, a company owned by Michael Saylor, got really extreme the other day. And we're seeing some signs of bulls getting a little bit too out of their skis, and that was where MicroStrategy pointed out. He said that Warren Buffett might be destroying some of its company's capital by not investing in Bitcoin. Those are kind of things you see when markets get a little silly, and I think it's just getting a little silly expensive now.
Mike, what's the role of Bitcoin ETFs been in the rise here of underlying Bitcoin?
Key thing, Paul, everything. So remember, that was the key thing when we launched that Bloomberg Galaxy Crypto Index in 2018. That was a primary goal. At some point, we're going to ETFs. The key thing flipped with Mr. Gensler finally approving them, and now with our crypto-friendly president. It used to be very anti-crypto, but total inflows this year around almost 30 billion. I understand that's the greatest ever for any new ETFs. Total ETFs tracking Bitcoin now is about 120 billion. Put that in context, a year ago it was only 10, so a lot of that's appreciation. And compared to gold, gold's only 220 billion. So gold ETFs have been around for 20 years, and so Bitcoin's catching up really fast.
Well, we can get to Bitcoin and just keep going with Bitcoin in a second. But to that point in gold, it's also had a tremendous rise. I mean, we're at the best week for gold prices since, October of 2023. If Bitcoin retrenches a bit here, like you're saying, can gold keep getting higher?
There you go, Alex. So and I both have commodities in our blood, and we all both know the only commodity that really goes up over time is gold. So I like to point out today,
who doesn't want gold
November,
in their blood, by the way? I mean, that sounds
great. Yeah, there you go. It's shiny and it's pretty, and it's such a unique element. But it's as of today, it's beating the S&P 500 total return on a 1, 2, and 3 year basis. So that's not a good sign for risk assets. And I point out this is very similar to 2007 when volatility was bottoming. So I love watching that gold gold Bitcoin ratio. I think Bitcoin's got to punch above it and stay above this 37 or gold ounces. Otherwise, it's good resistance. But the key thing, remember, about gold is every day that goes by, we see geopolitical tensions escalating. Gold's favorable. And then you see issues what's happening lately. I pointed out gold's beating the stock market. That's not a good sign. And the Fed rate cutting 75 basis points and bond yields and mortgage rates going up about 75 basis points. That's not a good sign. I think a lot of those things favor gold.
All right, let's switch gears right into Alex's wheelhouse. Mike, energy, WTI crude oil, back above $71 a barrel. What's driving oil these days?
Well, we're getting a decent bottom in the market from these geopolitical tensions. We all know futures got way sold out. They're really priced for a bear market, but we do have agreement from the EIA, the IEA, and OPEC. These are the main agencies that predict where markets are going, that demand is going to decline. That's completely juxtaposed to about a year or two ago when they thought demand was going to increase. So it's all tilting that way. So it raises a little bit of my contrarian instincts as a commodity trader, but overall, I think what has to happen in crude oils, unless there's some kind of major supply shock, which we're not getting, it has to basically sustain for a certain period below the average cost of production in the U.S. is around $56 a barrel before we really see supply to curtail and demand to pick up. And guess what? How unprofound that isn't? That's the lessons of Adam Smith from almost 300 years ago. It's all heading that way. Natural gas basically did it back in the first half. It had to trade well below 2 before it bottomed.
Do you think that the drill, baby, drill scenario is actually going to materialize?
The key thing about it, Alex, it's within underlying trends that are very bad for prices. So diesel demand in the U.S., unleaded gas demand in the U.S. are declining. Diesel demand is declining versus across the world. So we're seeing declining demand, and we see massive excesses of the exports of U.S. Crude oil, which used to be an oxymoron, continue to increase. So increasing supply, decreasing demand, even before the drill it will. So the world's tilting that way, and this is going to just accelerate. So yes, I do. I think crude oil is going to drop below 56. I've been saying 40 for too long. You know who to blame if it doesn't work, and it has to really sustain above 80 to really show anything signs of technical upside, but otherwise it's the supply, demand, technicals, everything are pointing downward, and that's completely the opposite of gold. Everything's still pointing upward.
All right, Mike, I know you came from the farm country in the Midwest. What does the farmer do today in Illinois, Indiana, Iowa, Nebraska? Haven't they pulled their stuff out of the ground already? And don't they plant not until the spring? So what do they do in November?
Every day I go by, every word I hear, the other word is Brazil. And this is something that's really changed over the last 10 years. So right now, the bins are completely locked up and massively full in the U.S. Best corn crop ever, 183 bushels per acre. That's double what it was 50 years ago. The stocks to use of soybeans on a global basis is well over 1/3. That's like the highest in 20 years. And now we basically need a bad production year. You need bad weather in Brazil, or else we're going to see that massive supply still to come on. And the bottom line is don't underestimate elasticity in grains. It's that big pump in prices because of Russia's invasion of Ukraine that really spiked up the incentive to boost most production in Brazil. And now Brazil is one of the top exporters of corn, beating the U.S. very close there. And they started exporting more soybeans in the U.S. almost 10 years ago. The trend is really strong. And then also it's demand from China. China is really starting to adopt genetically modified seeds and things. So they need a little less. And most of their imports are coming from Brazil. So when I go out to the Midwest, oftentimes the quote I heard lately was, Mark Twain says you might as well buy land because they don't make anymore. Out in the Midwest, they say, well, they are in Brazil.
Yeah, and the question really becomes if we get more tariffs, right? And then what that does to farmer exports in terms of soybeans and corn to China, TBD on sort of what that winds up meaning, Mike, yeah?
Absolutely. We have a glut of energy, agriculture, and grains in this country. And if there's any type of trade war, that means we're going to have that glut's going to increase. It'll be harder to export. So, yeah, it's a pressure for prices. And we basically have to expect Robert Lighthizer book where he said there's no free trade to not pan out. And now that we have the complete Republican sweep, I expect we're going to get what they said they're going to do and get tariffs across the board.
All right, Mike, thanks so much. Really appreciate it. Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. Now, what would you like to hear about on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg Audience Survey. Visit youtube.com/Bloomberg Podcast and click the link in our profile or community section to take the survey. It's hosted by our partners Material. Fill it out now at youtube.com/Bloomberg Podcast. All right, coming up, we're going to talk to Jessica Kriegel, Chief Strategy Officer of Workforce and Labor, on the potential slide slashing of federal workforce. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday. We made it to the end of the week. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. We also tap an amazing network of resources outside of Bloomberg Intelligence, and we're going to tap one right now. Jessica Kriegel is Chief Strategy Officer of Workforce and Labor at Culture Partners. She joins us now from Sacramento, California. So the headline from this week that we didn't really get to digest as much was Elon Musk and Vivek Ramaswamy outlining a plan for large-scale firings of the federal workforce. In part, guys, get your butt backs in the office 5 days a week. You don't want to do it, and then you're going to quit. Is this realistic? What's your take on something like this?
Well, they argue that it is absolutely realistic, and you've already seen a precedent set in the corporate world where people are forcing employees back into the office 5 days a week. What is a little bit different, or maybe even refreshing, you could argue, is that they are being straightforward about the fact that they anticipate by forcing people back into the office 5 days a week that people will quit, and they welcome that. I think that's probably true for a lot of CEOs who make that decision because they know their workforce values flexibility, and yet they're forcing them to go back into the office. So they are being, in some ways, at least transparent that there is a alternative motivation for forcing people back into the office. It's not about quote unquote culture. It's not about quote unquote collaboration. It's really about we want to reduce the workforce, and this is one of the many tools that we will use.
So I guess in the federal government, again, Elon Musk, Vivek Ramaswamy, what do you think they could do, should do when you think about, I don't know, waste, inefficiency, bureaucracy? Is there a preferred way to kind of go about this, or do you just take a cleaver and lop off 10%?
Well, should do I'll leave that up to the political analysts, but what I will say is they're arguing that the bureaucracy is wildly inefficient, and they're not wrong, because if you look at accountability in bureaucracies as compared to the free markets, there is less accountability, right? There's less consequences for failure in a bureaucracy, there's less competition, and so accountability necessarily goes down, and they're saying we need to address that. It's not necessarily a problem, the size of the federal government. The federal government is the largest employer in America with 3 million employees, but size isn't in and of itself the problem, right? Look at Amazon. Amazon has 1.5 million employees, and they could deliver a banned book to your doorstep in the next 8 hours, right? The problem is the lack of accountability, and that is in particular what they are wanting to address with, yes, it sounds like a cleaver.
How do they do that okay, so let's say that they didn't just do the cleaver. How do you transform culture and help productivity in a government agency?
Well, what we know from helping companies transform culture is that culture does not go down without a fight. So this is going to be incredibly disruptive. And here's the pros and cons of disruption. Innovation comes from disruption. You cannot have innovation without disruption. But disruption does not, in and of itself, create innovation, right? Disruption can simply be catastrophic to culture. And so what they are doing is they are creating an opportunity, but they are also creating a potential massive headache. And I do believe from the federal workers and also from the public, there will be resistance to change. There's always resistance to massive change like this. And what we've also seen is the best things come from the organizations that embrace change. So the extent to which the federal workers and the public are able to embrace this change will probably have a lot to do with how well this is going to end up.
I feel like I have to ask, because for a while there, this was a big issue for me, but where is the U.S. private sector economy in terms of work from home, hybrid, that type of thing? Have we settled into a new normal, or are the sands still shifting there?
They're still shifting. So we see various plateaus in what normal is year over year. I believe I'm coming out soon with an article on the workplace trends of 2025. The year 2025 is going to be the year of forcing people back into the office 5 days a week. Usually what happens is there's a lot of press about one big deal CEO forcing people back into the office, which has already happened, and now it's happening again with this announcement from Vivek and Elon. And so next year, that empowers other leaders who wish their employees were back in the office to get back into the office, and you're going to continue to see a push. We had plateaued at around 3 days a week, but it's going to go even more back into the office next year.
Okay, but this means then that my commute in on Fridays and Mondays now will be more trafficked.
Yes.
I don't love that. I don't love
No.
that for me.
No.
Like, we're already here 5 days a week. But I've been here 5 days a week since June of 2020. So it's like, yeah, whatever, but don't make my traffic bad.
No.
That's a bummer.
Exactly.
All right, we really appreciate it. Thank you so much for all your insight on this. Jessica Kriegel is Chief Strategy Officer of Workforce and Labor for Culture Partners, joining us on that. Speaking of, I don't know, nothing in culture.
But it's interesting. Like, I talked to my 28-year-old daughter who has only worked really started working kind of in a pandemic era. It's not even, I guess they can reprogram, but for a while there, it wasn't even in her DNA to do that, to come in 5 days a week. I mean,
That's
she felt
just crazy.
Yeah, so I think they're getting
so weird.
reprogrammed back because they're now in 4 days a week at her employer, which will likely go to 5. But for a while there, it just wasn't even in her DNA to think about that.
Wow. I mean, I understand having a flex day here and there,
Yes.
or like, hey, my kid's sick, I got to work from home.
Right.
Okay, great. But like, that
Yeah.
feels like an exception. Sort
Right,
of.
it does, and I think, as Jessica was saying, it's slowly been going back to work from home, work from the office, but we'll see how that plays out. I still see a lot of vacant commercial space here in the city, so
Oh my
I don't
God,
know.
yeah. Although across the street on Lex, it looks like they're doing
Yes,
some construction on
they
that
are.
massive retail space.
Yes.
Anyway, that's just food for thought. All right, coming up, we got a great hour lined up for you. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, will be joining us. His thoughts on Gary Gensler's departure plus Trump appointments. And John Butler, Bloomberg Intelligence Senior Telecom Analyst, will talk about DirecTV and Dish. It's over. It's done. I don't know. What does that mean? We're going to break that down. This is Bloomberg Intelligence. Happy Friday.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. Welcome. We have a great hour lined up for you. We're going to go to D.C. with Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, with his thoughts on Gary Gensler's departure and where we are with that Treasury Secretary nomination. And John Butler, Bloomberg Intelligence Senior Telecom Analyst, will talk to us about DirecTV and Dish calling it off. Plus, it is Friday. Munis in focus. I have missed the Munis. Bam. We will get to that with Eric Kazatsky, Bloomberg Intelligence Senior Muni Strategist, and Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. Media. Plus, apparently they're doing like a GICID. Did you hear about this?
Glickid?
Glickid? Is it
Yes,
Glickid?
I
The
don't
Wicked and the Gladiator
Yep.
thing together.
Yep.
They're trying to make it a Barbie Oppenheimer situation. I don't think it's going to go that far, but nonetheless, we will break that down for you. But let's kick off the whole hour right now with Charlie Pellet for Bloomberg Business Flash.
Hi, thank you very much. All back in the office, and nothing wicked about the market right now with the Dow, the S&P, NASDAQ, all advancing. 19-point gain right now on the S&P. We're at 59.68, up by about 0.3%. The Dow now up 277, up 0.6%. NASDAQ up 19, up by about 0.1%. Traders snapping up shares in blue chip and small cap stocks after a positive reading on U.S. business activity. 10-year yield 4.41%, the 2-year 4.36%. Gold surging $32 the ounce, 27.02 on the precious metal, up 1.2%, and Brent crude up just about 1%, 74.95 a barrel. WTI at 71 a barrel, up by 1.3%. Consumer sentiment is measured by the University of Michigan, up in November by less than previously reported, reflecting deep divisions among Republicans and Democrats about the path for the economy after Donald Trump's presidential election win. Joanne Chu is Director of Surveys of Consumers at the University of Michigan, and she was interviewed right here on Bloomberg Intelligence.
Essentially, what we saw was that after Trump was elected, sentiment lost about half of the gains that it had seen in the first 2 weeks of the month. But on net, we're still a little bit better than we were in October, and we are now at 4 straight months of incremental gains.
Joanne Chu of the University of Michigan, interviewed here on Bloomberg Intelligence. Gap shares surging after raising its full-year outlook as the apparel retailer attracts wealthier shoppers seeking value. Gap up now by 8.5%. Other retailers advancing, clothing retailers advancing, shares of Abercrombie & Fitch up by 5.8%, Urban Outfitters up by 4.3%. Also, after earnings, Intuit shares, they're slumping now by 4.7%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. As Charlie was just telling you, a little bit of green on the screen here, led by the Dow Jones Industrial. Let's check out where the action is under the hood. We do that with Abigail Doolittle, markets correspondent for Bloomberg here. Abigail, what are you looking at?
I'm looking at stocks higher on the week. After a down week last week, we have the Trump trade fully back in effect. The S&P 500 up more than 1%. The same is true for the NASDAQ 100 and the stocks. And interestingly, the real sign of the Trump trade, the Russell 2000 up more than 3%. Those small cap domestically based stocks could do better under a protectionist, administration as is anticipated. I'm also watching Super Microcomputer. This stock up about 80% on the week. Its best week ever, and this on the possibility that they are going to live to see another day. I mean, the volatility around this company is just incredible. I've spent a fair amount of time on the phone with Woo Jin Ho, our Bloomberg Intelligence analyst, and initially he was really saying that he thought that this was the case of a small company, a small cap company, all of a sudden in the spotlight. They didn't really know how to manage the financials from the bigger spotlight and regulation. The last time I spoke to him, he was a little bit more concerned, but listen, this week they do have an auditor in place, BDO, after their old one left, and they're in talks with the NASDAQ. They've put a plan in place to to file that delayed 10K and to stay listed. So that stock right now is the top percentage stock for the S&P 500.
Also Gap.
Yeah, Gap is up higher, although the last time I looked at the Gap, it was actually off of its highs. Let's take a quick look there using the SINS function in the Bloomberg terminal. Right now, it's up about 9% at the highs. It had been up 17.5%. Either way, the best day since May 31st. They put up a better quarter than expected, adjusted earnings beating by 25%. But the big deal is the full year sales guide, that comp guide, they're talking about a range of up to 2% growth as opposed to less than 1%. Those numbers are so slim, but it really shows you investors will take what they can get.
Even like, I mean, another retailer, Ross Stores. Again, I don't shop there, so can't.
I don't shop there either, so I can just.
I'm not sure what
forget.
Yeah, but I certainly know the name. But it's up, 2.8% today, so that's some decent numbers.
So I actually did shop at Gap for the first time in about 2 years, not so long ago, and I wore those jeans to work today, having no idea of the synchronicity. I wonder what it means, but they're great. And I also, it's funny. Some of these retailers, they go through quality issues. Right now, I would say is a high quality, and from a material standpoint, for Gap, just to know. But yes, Ross Stores also higher, up 2.8%. And I'm not so familiar with Ross Stores. I think I have been in one at one point or a couple times. I don't know if I actually bought anything from there, but their results are quote unquote better than feared, and that's enough to send that stock higher.
All right, Abigail, thank you so much. We appreciate it. Abigail Doolittle, Chief Markets Correspondent for Bloomberg News here. More news coming fast and furious out of Washington, D.C., out of, I guess, Mar-a-Lago down in Florida. That's the new headquarters for the Trump campaign.
The other Washington, D.C.
The others, yeah. South Florida, people are saying that's the real bastion of the Republican Party these days. Nathan Dean joins us, Bloomberg Intelligence Senior Policy Analyst. Nathan, let's talk with Gary Gensler, plans to depart the SEC in January. What's your take on his tenure?
Yeah, so I think a lot of it can be either reversed via the courts or by a future Republican, SEC chair. I mean, a lot that he pushed in, especially, is going to be well known in the cryptocurrency space. And, one of the immediate changes that will happen when Chairman Gensler resigns is you're going to have a change in enforcement risk for the cryptocurrency industry. Currently, the SEC is engaged in a lot of enforcement actions against crypto in general, and a new Republican-appointed SEC chair can essentially reverse or a lot of that. So I think that's going to be the immediate, catalyst, if you will, from Chairman Gensler's resigning. But going forward, the question is, what is a future SEC chair going to do? There's this combination of thought out there that maybe somebody from the crypto world is going to come forth and put in a new cryptocurrency rule. But then there's a lot of folks on Wall Street that also want to return to this idea of capital formation. And you're going to see a lot of changes, I think, in terms of deregulation from some of the rules that we've seen all the way from 2005, equity market structure, if you will, and so forth. But you could also see a change in the accredited investor definition to make it easier for individuals to invest in, hedge funds, private equity funds, and so forth. But ultimately, I think a lot of what Chairman Gensler did over the last 4 years, a lot of it could be overturned in the next few years by the courts.
What kind of names fit the bill of what you were just talking about?
Yeah, so, this is one of, I was actually joking earlier that I think that we're not seeing a lot of, well, let me rephrase this. I don't think President Trump is anywhere close to picking an SEC chairman. The reason being is, I've heard 15 names being floated for potential chairs. And to my mind, that means people are floating their names on behalf of themselves. It's not coming from Mar-a-Lago. So the question is, are you going to get somebody from the crypto world, like the back CFO or Dan Gallagher from, Robinhood, if you will, somebody that would be very pro-crypto? But crypto is also a very small subset of what the SEC oversees. So you could see somebody like former Commissioner Paul Atkins, or somebody that comes from the cloth of former Chairman Jay Clayton, now President Trump's pick to lead the SDNY. The question here, though, is, are you going to get a crypto pick, somebody who's really focused on crypto, or are you going to get somebody that looks more to Wall Street and more to the idea of this capital formation? I think ultimately President Trump will go with the latter. Certainly someone would be friendly to crypto, but also keeps Wall Street in mind when they're moving forward with their agenda.
So, Nathan, what's the feeling in D.C. today about the Attorney General situation here with Matt Gaetz stepping down from his nomination, recognizing that he probably will not get confirmation, and then Trump immediately naming Pam Bondi? What's the feeling in D.C. about how this is all playing out?
So, I think this was anticipated. I mean, we've heard Bloomberg News report that, several senators on the Republican side were no's on this. But what I would say is that it also frees up the Senate to move quicker with additional confirmations next year. And so it actually advances the timeline for tax reform, if you will. Because if we had a serious nomination fight over Matt Gaetz, that would slow things down in the Senate. The faster that President Trump can get his nominees in place, the faster Senate can forget about these nominees and actually move on to tax reform and other things within the first 100 days of President Trump's agenda. So anytime you see one of these nominees, and Tulsi Gabbard, for DNI is another one that's getting pretty hard scrutiny, if you see, an absence or withdrawal and replaced with somebody that we think would get a better chance of Senate passage, ultimately it should speed up your anticipation of when eventual tax reform bill comes due.
Let's just hit on Treasury Secretary real fast. The latest reporting out of the Wall Street Journal is that perhaps Kevin Warsh will be Treasury Secretary until he can replace Jay Powell at the Fed, and then maybe Scott Bessent will come from the NEC and then go be Treasury Secretary. That feels like a whole lot of jigsaw puzzling happening. What does that do for policy prediction?
But I think President Trump is doing this. I think this idea is being floated out there because President Trump wants speed. He does not want his nominees to be stuck around. The faster he can get them in place, the faster he can move forward. Now, if you put Kevin Warsh into the Treasury, I think it's somebody that Wall Street would be able to work with. I think it'd be a Wall Street-friendly pick. And if you have this idea that Scott Bessent is in the wings and Kevin will eventually move over to the Fed chair, they sort of implemented their goal of this shadow Fed chair, if you will, because if we know that Kevin Warsh is going to be nominated for the Fed for the next year, well, Jerome Powell's not really going to have much of a say. The markets are going to be paying attention to more of the Treasury Secretary than not. So from President Trump's perspective, he gets speed, he gets something that Wall Street is most likely in favorable of, and he gets this idea of putting pressure on Jerome Powell to essentially, finish out the rest of his term with a shadow chair behind him.
All right, Nathan, thank you so much. We appreciate that. Nathan Dean, he's a senior policy analyst at Bloomberg Intelligence, joining us from Washington, D.C. You want to switch gears here to the telecom space, to the M&A space. Dish Network, they wanted to merge with DirecTV, the two remaining satellite players, but the bondholders at Dish said, I don't think so, because you're going to ask us to take too much of a loss here. So they called that deal off today. Dish is owned by EchoStar Corp. SATS is a ticker, and that stock is down 2.7% today. John Butler joins us. He's a senior telecoms analyst for Bloomberg Intelligence down in Princeton. Hey, John, so this merger between DirecTV and Dish, it's called off. Now what happens for both of these companies?
So the good news for AT&T is that they are going to sell the rest of their stake of DirecTV to TPG. So for AT&T, in my mind, it's still a good move. Nothing changes here. But for EchoStar, they're now going to continue to be saddled with this large pay TV business, which, Paul, as you know from your media background, pay TV is just in this awful secular decline due to pressure from streaming. So bad news for EchoStar. They need to move to what I'm terming a plan B here and figure out how to ultimately divest themselves of the business. But as you said, it was a no-go with debt holders, and they needed to get their approval to get this deal done.
So who's the big loser in all of this?
Honestly, Alex, I think it's EchoStar here. I think TPG certainly would have benefited from having the greater scale from the Dish pay TV assets, but at the end of the day, I think the real problem lands squarely in EchoStar's lap for just the reason I said. Pay TV is a tough business. It's only getting tougher here. There's no bottoming that I see in the near future. And so they're going to have to manage that asset down. I mean, the good news here is that it is free cash flow positive for now, so it's going to help fund that 5G wireless build out. But again, it sort of leaves them with this large, ever declining asset on the P&L, and I think they really are anxious to get rid of it here.
Hey, John, I'm just looking at AT&T. Again, this is a name that everybody knows. It's been around forever.
Yes.
Stock's had a great year this year. It's up 38% year to date at a 52-week high. What's investor sentiment? What's the call here on AT&T? Why is the market rewarding this stock?
So the one thing I love about AT&T is they are leaning very hard into broadband, particularly fiber broadband. And when you think about fiber, unlike cable broadband, fiber is fully symmetrical. It offers higher speeds. And it really has incredible durability. I mean, it's fully waterproof, if you want to think of it that way. It really is impervious to environmental harm. So I think the whole market seems to be waking up to those advantages of fiber, and of all the providers out there, I think AT&T has the best head start there. So from the standpoint of convergence, which is sort of the monster theme in telecom right now, convergence between the traditional wireless business and the broadband business, AT&T, of the big three telcos, I think is in the most favorable position with those terrific fiber assets.
With a new administration coming in, how does this affect this sector in terms of M&A or growth or any of those things?
So, Alex, the feeling is, from an M&A standpoint, it's going to be an easier ride for all companies, not just telcos. But we've seen convergence continue in the wireless sector. You know, you've got T-Mobile buying TDS, you've got Verizon buying Frontier. And so as that consolidation continues, perhaps even between cable and telco at some point further down the road, I think a Republican administration, at least the perception is, they're going to be easier in terms of deal scrutiny. So they win on that front. And also from a taxation standpoint, obviously, again, this benefits all companies, not just telcos. But I think we could see further cuts to corporate tax rates, which would be very favorable for the telecoms.
John, you mentioned broadband. What's the cable television response? What's Comcast and Charter? How are they responding to the AT&Ts and Verizons of the world?
So I don't cover cable, but I will tell you, Paul, they're upgrading their plan, and also they too are driving fiber, getting into fiber broadband, which I think, in the end, anyone who offers broadband is ultimately going to have to migrate to fiber assets, I believe, because of, again, that superior capacity. I mean, it just offers these lightning fast speeds, or if you want to think of it in industry jargon, this incredible bandwidth. And cable plant, the coaxial cable that the cable operators are using, is really good and good enough for now, but it doesn't offer the same bandwidth, the same speeds, download and upload speeds that you get from fiber. So the cable operators are looking at that market and driving more fiber in their networks.
All right, John, thanks so much for joining us as always. John Butler, he's the senior telecoms analyst for Bloomberg Intelligence, joining us from BI's corporate campus down there in Princeton, New Jersey. Again, AT&T just having a good year. The stock had been such an underperformer for such a long time. Nobody could really figure out what their strategy is. Were they trying to become a media entertainment company? Are they really leaning into their telecom heritage? They were kind of all over the place there for more than a decade, but kind of focusing now, and I think the street kind of likes it. S&P 500 up 9 points, Dow up 217, NASDAQ a little bit in the red there, off 13 points. A little more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. A little change right now on the S&P 500 index, up 6. That is a gain of just about 1/10%. Dow Industrials, though, up 212, up 0.5%. And a retreat for the NASDAQ Composite Index, down 0.2%. The NASDAQ 100 Index also down 0.2%. The Russell 2000 Index, though, ripping higher, up by 1.3%. 10-year at 4.40%. The 2-year 4.36%. Gold now at $27.03 the ounce, up 1.3%. West Texas Intermediate crude up 1%, 70.77 a barrel. And Bitcoin now at 98,682, up by 0.6%. Traders are snapping up shares of blue chip and small cap stocks after a positive reading on business activity. The dollar higher on course for an 8th straight week of gains. That would be the currency's longest run of the year. Honeywell International has agreed to sell its personal protective equipment unit for about $1.3 billion, the latest in a series of portfolio changes for the big manufacturer that is facing calls from an activist to break up. Honeywell shares, they're up by 1.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Munis in Focus is brought to you by Build America Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Learn more about municipal bond credit quality. Visit bambonds.com. Let's check in with Eric Kazaski, Senior Municipal Strategist for Bloomberg Intelligence. He's based down there in Princeton, New Jersey. Bonds are doing a little bit better here in the month of November. Eric, talk to us about the muni bond space. Did they participate?
Yeah, absolutely. Look, they're wildly outperforming treasuries, which is really what we want to see, right? For those who are sort of value shoppers. But I think the story is, volatility in our space has really sort of led to these better returns. And we're sort of tracking along with previous Novembers where we've had really strong total returns coming into investors. And I think it's a feel-good story right now.
Where in anything in particular where you're seeing the better performance, Eric, or is it kind of across the board for the munis?
No, it's definitely in those credit and spread sectors, definitely like lower down the credit stack, talking like high yield munis, things that have really sort of been outperforming all year. They've continued to sort of truck along. But, when we look at different coupon stacks, it's definitely people are showing a preference for, paying up for a 5% coupon, sort of being a little bit more defensive as far as their future purchases and trying to offset any sort of rise in rates that might come along in the future.
Eric, where do you see flows going? Like, is money coming out of things like money market funds and going into munis as sort of treasury yields? Well, at one point they were going lower, and now they're over 4%.
Yeah, I mean, look, we're seeing continual flows into munis. We can't exactly trace where they're coming from. Not a lot looks like it's coming out of muni money market funds. They still seem to be collecting assets. But it really is just a lot of cash that's coming back to investors on a monthly basis is immediately being redeployed into the space. Especially like new money coming in that's separate and aside from that is, readily flowing into the exchange traded fund space and also the SMA space. So, definitely they're outperformers when it comes to, getting new assets and growing those over time.
How about what's been the election effect for the municipal bond market? Eric, what have you seen?
Yeah. I am pretty sanguine if you sort of think about the potential for disruption coming into 2025, right? So we have President-elect Trump, or President Trump, however you want to phrase it, coming back into office. And he really is focused on extending with some permanence some of those provisions in the Tax Cuts and Jobs Act. What really is the big question mark for the muni space is, can any of the portions of the tax exemption or the exemption at whole really be under threat? And we are hearing increased chatter when it comes to sort of more concerns when it comes to that. They can't outright cancel the tax exemption, but they certainly could sort of, put a cap on what that exemption is worth and sort of go about it that way, which would obviously like impact the value of muni bonds. How that would play out is really sort of fan fiction or conjecture on our part at this point, but, we are trying to sort of put a note together to sort of think about what the world would look like in a post-exemption space.
Can you tease the note a little bit? What might that look like?
Well, look, I mean, like, and I know people in my space really hate when I say this, but if munis all of a sudden found themselves, taxable, I don't think it would be the worst thing in the world because you'd have a ton of new buyers coming into the space, right? We have a very different risk profile than, let's say, corporate credits, and you'd have a bunch of issuers who would really sort of bulk up in size, right? You'd lose a portion of the market that are really these small muni deals that come to the market, these small towns, small school districts, small charter schools. They would really not be accessing the muni market. So you'd have larger sort of index eligible corporate size deals, and that would attract money from overseas and pension funds here, and banks and corporations have really been sitting on the sideline when it comes to munis right now because of the tax disadvantage.
Eric, thank you so much. Appreciate it as always. Eric Kazatsky, Senior Municipal Strategist for Bloomberg Intelligence, based down in our Princeton office. All right, Charlie Pellet just informed us that he's going to go see Wicked Sunday afternoon. So if Charlie Pellet is going,
Not afternoon, morning.
Morning, exactly. Okay, morning.
I don't know what that's about, but there you go.
Well, maybe it's just sign to take tickets might be tough to get here. Let's break it down because it is the beginning of a big season for Hollywood. Just kind of now between the holidays is really after the summertime, their biggest season in terms of releases and revenue and so on. Geetha Ranganathan joins us, Bloomberg Intelligence analyst. She covers the U.S. media. We're going to get to her in a minute because I think Eric was on the camera. So now he steps off the camera and Geetha's going to step on the camera. That's how they do it down there. That's how they do it down in Princeton. But I'll go take a look. I mean,
well, apparently no, but apparently it's a thing in that there were stories, I think it was a journal, like a woman rented out a movie theater for Wicked, but then there were super strict rules because everyone's going to want to sing it. I mean, this thing's been around for 20 plus years, right?
So there's no singing rules?
So then there are no singing rules. There are some that are sing-alongs that you can do. Have you seen Wicked?
I've seen the play. Yes, I've seen the play back in the day. So maybe I'll check it out. I don't know. You know what? I for anything to see if it's in the zeitgeist or not, as Tom Keene would say, I check in with my 28-year-old daughter. If it's in her wheelhouse, then I know it's cool, and I'll go see it.
I would put money that she's seeing it.
Okay, we'll check it out. I'll text her. We'll see what happens. Geetha joins us now. Geetha Ranganathan, the media analyst for Bloomberg Intelligence. Hey, Geetha, talk to us about kind of these two movies here. What do they mean kind of for, I guess, their studios? What do they mean for the theater business? Give us a sense of kind of how this season is shaping up.
Sure, Paul. Thank you. So this is a big weekend for Hollywood. I mean, this is almost reminiscent of, Barbenheimer, because you have these two big movies, one from Universal, which is Wicked, the Broadway adaptation, and then you have Gladiator 2 coming from Paramount. Again, people are kind of trying to ship those two together, so they're calling it now Glicked, very similar to kind of the whole Barbenheimer thing. So you have two movies storming the theaters, a lot of star power, a lot of marketing prowess, and then, of course, a lot of great IP. And this is arguably going to be one of the most anticipated weekends to kick off the holiday box office season. And it means a lot for Hollywood. And I think at this point, what we're seeing with box office is it's still down about 10 to 11% versus last year. So we're hoping that, these two movies, and then of course you have another huge one coming out next week with Moana 2, kind of really get us closer to that 9 billion mark.
You laugh. Moana's awesome.
I know.
And then Lin-Manuel Miranda should also, right? I mean, he wrote Moana 1.
Oh, I'm a big fan of his.
In terms of the music, so I'm wondering the heavy hand for Moana 2. Is this going to deliver, Geetha?
I think it is. I think these three movies, Alex, and so the next 10 days are absolutely critical for, for the three studios, of course, and of course for box office in general. And it really kind of sets the tone, not just for the holiday season, but also for 2025, which is shaping up to be arguably the best year since the pandemic. So we think it absolutely delivers. People are going to come out. I mean, we've seen pre-ticket sales through the roof. Especially for Wicked, especially for Moana 2. So those are definitely going to do extremely well.
So have we had to come to or arrived at, Geetha, a new normal for theater-going activity? Like, where are we kind of today? And I don't know, tickets sold versus maybe pre-pandemic. Have we settled into a new normal?
I think we are, slowly but surely. So, of course, you had the pandemic, you had a demand shortage. And then, of course, with the strikes, you kind of had a supply scarcity with, not so many films coming out. And that's what we saw in both a little bit in 2023 as well as in 2024. So 2023, we just were shy of $9 billion. Remember, in the pre-pandemic days, it was $11 billion. So that was basically the benchmark that everybody is kind of looking to. 2023, we got to 9 billion. This year, we started out saying it's going to be about 8 billion. Then, of course, you had the big Inside Out 2 movie, did really, really well, big numbers with Deadpool and Wolverine. And then, of course, now you have, you know, this triple feature, right? You have Glickit, and then you have Moana 2, and then we're ending off the year with Mufasa. So again, the hopes are, the big expectation is that we might be able to get to about anywhere from about 8.6 to 8.8 billion this year. But then, of course, next year is really where everybody is kind of really setting their sights for getting to that 10 billion mark. So the new normal is probably going to be 10 billion, and we're probably going to get there next year.
So, you know, I was thinking about you the other day because I was like, I really want to go to a movie. And I was like, there's nothing out there that I care about. So, and I appreciate that the next couple weeks is going to be key for those 3 movies. But what about next year? Do we finally get the pipeline really delivering?
Yes, 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 we do. So you have a big Avatar movie coming out, Alex. You have Mission Impossible. You know, you have this John Wick spinoff. You have a Fantastic Four movie. You have a new Jurassic World movie. You know, you have a Superman reboot. You name it, you have it. So it's across the board. All of the studios are coming out, you know, guns blazing for 2025.
All right, Geetha, while we have you, let's talk about some of the problem childs in your space. I'm thinking Paramount, thinking Warner Brothers, Discovery. Any new thinking on how those 2 companies strategically proceed from here?
Yeah, so there was something really interesting that happened this week, Paul, which was basically Comcast, which spun off or which has decided to spin off its cable networks division, its cable TV networks division. They're hoping that those networks will be spun off completely within a year's time. And so the question then becomes, you know, does that kind of become a roll-up acquisition vehicle for all of these other TV networks? We know that both Warner Brothers as well as Paramount have very, very heavy exposure to the linear TV model, especially the cable networks, both of them getting about 50 to 60% of revenues from those cable TV networks. So it's going to be interesting to see exactly what happens, but there's absolutely no denying that that business is extremely challenged. We're seeing about 8 to 9% of yearly TV subscriber losses. So something has to be done. And, you know, the general expectation is that there is going to be quite a bit of M&A activity on the street, considering especially this Comcast spinoff.
Maybe I'll dust off my Rolodex and get back in the game.
Yeah, and you think it also gets better because we have a different administration? So does that get easier to kind of push
I think
through?
so from a regulatory perspective, because that's the FCC, the Federal Communications Commission, as well as the other just competitive folks like FTC and DOJ. Geetha Ranganathan, thank you so much. We appreciate it. As always, Geetha is our go-to voice, one of the leading media research analysts on Wall Street, talking about going to be some pretty good movies coming up if you're into that thing.
I'm into that thing.
Yeah, I think so.
Well, because in my local theater, they have like really amazing food.
Ah.
And they do like table service to your seat.
Nice.
And they do like special drinks, like based on the shows. Like it's super fun.
And that'll cost you per ticket?
Well, I just bought 3 tickets from Ron at 2 for $56.
Okay, I'll do that.
And it's not, you know.
It's
a whole thing would be like
It's a whole thing.
It's like $130 for 3 people to have dinner and have a movie.
Okay, all right, that's how you roll,
And some
Brooklyn.
drinks. This is Bloomberg.